Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, last day of 2025. And here we are. So look back and look ahead, that time of the year. This is, of course, a program where we will tell you everything you need to know with regards to today's trading action, but also maybe a little, longer than just one day. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Mangalam. Guys, morning.
Hi, morning guys.
You called it the anti-ultimate. Yesterday was the penultimate, and today is the ultimate trading session of 2025.
Here we are. Another year rolls on. It's been such an eventful one. A year filled with lessons for the market, and I think professionally and personally for all of us as well. And folks, today is a very, very special edition of Bazaar for me. We'll talk more about it as we go forward, maybe towards the end of the show. But it's been such an honor and privilege to be hosting this fantastic show for so many years with you all. But I'll just leave it there for now.
It's been a privilege, Surabhi. And Surabhi turns a new leaf, new chapter.
A new chapter, yeah.
Quite literally, in that sense, maybe.
Not quite going away, but in the new year.
In the vicinity.
In the vicinity. In the new year, time for something new. But we'll talk about that later.
Few desks away. Well, let's just quickly take you through what you need to know. But I'll just say this, right? I mean, when you look back into 2025, you just realize that, what was the biggest kind of sort of upside-down event? It was not like a single thing, but it was basically something which nobody really anticipated at all. I mean, think about it, January 2025, the expectation, the hope was that India is the first in the line to get a trade deal. And as we wrap up 2025, I mean, I think with the exception of China, on a weighted average basis, we are the worst affected in terms of tariffs. So that's markets for you. I mean, trying to predict what's going to happen into the year ahead. I mean, I think, most often than not becomes a bit of a fool's errand. So with that short preamble, let me just quickly take you through the here and now, right? Not very much, really. So S&P down a little bit more. And down about 0.14, NASDAQ down about 0.24. A little bit here, a little bit there, but not really going anywhere. The big talking point, of course, has been silver. And silver seems to be pretty much trading like a meme stock. By the way, there was the FOMC minutes which came through. And, the decision to lower rates earlier this month, the minutes showed was a bit of a close call. So that's it. That's the only kind of data point which kind of markets latched onto for the lack of anything else. Now silver, right? Meme silver, 9% rally last night, sharpest one-day gain since 2009, after the biggest one-day drop the day prior in 5 years. So what's going on here? When you get these very violent, concentrated moves, it's usually an indication of something that maybe. There is the price action is telling you there is hesitation, there is confusion about the road ahead. Maybe I've not looked at volumes, etc. What is the volume which is backing this kind of price move? But typically, this kind of indecision after a very, very large, furious rally indicates that people are trying to figure out. You're at a fork in the road, and you're trying to figure out what to do from here. So keep an eye. This is I think. Maybe things will settle down, but usually it settles down after a bit of a move. Either a big blowout move or perhaps a bit of a pullback, which we saw day before yesterday. All right, well, just a couple of single stock items, especially on the technology side. Meta has acquired an AI startup, Manus. Now, all year through, actually, especially the last 6 months, every day there has been something or the other with regards to, AI deal or a funding or something or the other. Tesla, by the way, posted a downbeat sales outlook for the fourth quarter. Stock was down slightly. Warner Brothers from the media TMT space said it plans to reject a takeover bid from Paramount after Paramount changed some, terms in terms of what it offered. So that's it. That's the US session. I think the only standout price action was with regards to precious metals and silver, which saw that sharp rebound. US equities will trade full day when they open up later tonight. Bond markets will close early. First, though, is a different thing, and we'll talk more about that later. Markets, of course, yesterday ended flat, but they were off the lows, especially in the last 15 minutes. There was a push which came through. And the Nifty ended unchanged. The Nifty Bank was trading much better through the course of the day. And mid-caps and small-caps also ended off the lows by quite a bit. Now, Nifty and the Nifty Bank, they are both, by the way, below the 20-day moving average, but they are taking support. They broke the 40-day exponential moving average yesterday, intraday, but they closed above it. So both of them are taking support of the 40-day exponential, which is, 0.5% to 1.5% away on both these indices. The supports are on your screen, the 40 days. So 25,898 and 58,759 are those levels for the Nifty and the Nifty Bank. Numbers we put out yesterday as well, of course, small change with the price action yesterday. Metals, PSU banks and autos were the top performers in trade. And we talked about metals a little bit yesterday. Names like Hindustan Copper ending about 10% higher. And by the way, all three are some of the top winners. Each of these indices for 25 up over 20%. Some are actually closer to 30%. So ending in style yesterday. Cabinet meeting today at 11 a.m. and the big talking point, the big discussion, we don't know yet, but will Vodafone Idea feature on that cabinet agenda? If it is, I think it could be important for the stock. It's already at about 12 rupees, a lakh odd crores in market cap, more than lakh 30 odd thousand crores in market cap. But it's a big one for Vodafone Idea. We'll see. We'll try and get you details as we go along. So that's it. That's the setup this last day. But Mangalam is standing by. He's walked across with the F&O positioning and how that's looking. Mangalam, over to you.
Good morning. So it's the last day of 2025 calendar year, but it's also the first day of a new series, the Jan 2026 series. And it's interesting because we start with a couple of important data points from a trader's standpoint. The Nifty lot has been revised from 75 to 65. Nifty Bank lot size has been revised from 35 to 30 as well. So that's Nifty Bank. Additionally, there are 4 new stocks which are trading in the F&O from today. We have Swiggy, Bajaj Holdings, Vari Energies and Premier Energies. So all these stocks will be on our radar. But let's look back and, over the last 2 series, the market's not done much. It's been a bit of a range. So November series down 51 points, December series up 54 points. So not a big change from where we ended in October, which was a 1,300-point rally. And that's exactly what the street is anticipating over the next 3 months. Why do I say that? Because historically, Jan series has been one of big moves on the upside. But last 4 Jan series, we've seen some consolidatory moves. 0.5% in Jan 2022, between 1.5% to 2% in the subsequent 3 years. Where does that go is something that we will be tracking very, very closely. And basis that, the rollovers from December to Jan have been at 72% versus 76%. A bit of this decline could also be explained by the lower number of lot sizes or the revised lot size. So on an average, the rollovers have been pretty much the same. What's very interesting is that the FII positioning, they are at the start of the series just 9% long. It's been coming down gradually after 20% post the October outperformance and 15%, because of the November consolidation. We're now starting Jan series with just 9% long position. Is that a bad thing? No, because if you look at it, over the last 5 or 6 series, the FII net exposure, which is at net 1.44 lakh contracts, and the clients, which are the HNIs, they are fairly long on the index. They have a 74% long exposure, nearly 1.18 lakh contracts. And every time all these 3 happen together, the market's poised for a big move over the next few series. Why do I say that? Because the last time this happened was September 2025, where the Nifty started with 8%, or the FI started with 8% long exposure in index futures. Over the next 2 series, we saw a 1,400-point up move. Prior to that, in February, 11% long positions. Next 5 series, 2,300 points on the way up on the Nifty. And then similarly, in 23 and April and November, the FI started the series with just 9 and 11% long exposure. And over the next 4 and 2 series, we've seen anywhere between 2,500 to 2,900 points. So Jan 2026, we start with 9% long exposure. Over the next 2 series, what does the market do? We'll try and revisit that as well. For now, what are the triggers? The Q3 FY26 results and updates around that. Developments around US-India trade deal. We'll closely monitor the FII flow or the FPI flow. and pre-budget consultations, news flow, or any sort of news around the cabinet ministers, etc., would be very crucial for the January series.
Oh, yes, absolutely. Those FPI flows. And we'll talk more about the flows with our next guest. But first, I thought we'll quickly do a check around the region and see how Asian markets are faring. There's actually a little bit of red on the screens. The trade is thin, volumes are thin, as you'd expect. And some of the markets like Australia and Hong Kong, anyway, are going to be shutting early to get ready to usher in the new year. By the way, there's some good economic data out of China this morning. The PMI numbers that have come, the manufacturing PI, the non-manufacturing, even the composite PI, all of them above estimates and in expansion territory. Manufacturing PMI has moved to expansion for the first time in 9 months in China. First time since March. So maybe not ending 2025 on a very somber note, which has been the story for China in terms of just the macroeconomy for the better part of the year. Anyway, let's pull up the GIFT Nifty and the implied open to see what sense we'll get. Yesterday, thanks to the expiry factors, at least we had a pullback from the lows of the session. Today is a new day, so we'll see how it plays out. Right now, absolutely flat. No indication of which way things could head. That's the Nifty, not even 1 point lower in the implied session. Okay, so let's take the conversation forward with the Cameron Brandt, Director of Research at EPFR Global. Cameron, great to have you with us. Season's greetings. Wish you a very, very happy new year. And, hope you've had a great Christmas as well. So the point that my colleague Mangalam was just making, for us, we've spent the better part of this year tracking those FPI numbers, foreign investor numbers into India. And actually, unfortunately, even as far as December goes, those flows are negative in India. Do you see any new trends emerging?
Not in terms of willingness to take on direct foreign exposure. But what I am seeing is considerable interest in diversified emerging markets funds, which is usually a precursor to an upward leg for all emerging markets. India gets a healthy chunk of anything that goes into a GEM fund. What I'm hearing, India specific, is a warming trend that's not really been matched by additional flows.
So as far as flows to Asia are concerned, what are you seeing in terms of some of the other markets like China, like South Korea, which has been the rocker of a rally in 25? Are the flows to these other Asian markets still going as strong?
Yes, so the answer is yes. Strong flows to both equity funds dedicated to both those markets in the past few weeks. What has been, I think, more significant is the pivot towards fixed income fund groups. What we've seen in the sort of final 6 weeks of the year, and this applies to emerging markets as well, is a real focus on increasing exposure to debt funds.
Right. What then do you think could, turn in favor of India when it comes to flows? What are some of the key monitorables that you'll be watching out for?
Well, I think it's more of a thematic shift. As I said, the commentary around India is generally fairly positive, but especially in the US with this intense focus on artificial intelligence, markets that don't have a sort of development AI story to tell, and the US and China are obviously way out in front in this, are just not getting the attention of those two major markets.
Also, when it comes to rotation away from the AI trade, we've seen some broad basing of the US market rally itself. Can you give us any more color on that?
Yeah, we've certainly seen a very sort of pronounced shift towards getting more diversified exposure. There's been some really serious kicking of the tires on the AI theme. One manifestation that we've seen is that investors are showing less enthusiasm for technology sector and dedicated AI funds and rotating to the infrastructure funds to get exposure to the massive build out of data centers, that being a more tangible outcome at the moment than the broader AI story.
Yeah, no, absolutely. And I think, the numbers are staggering, right? It's just, NASDAQ is up, Cameroon, 22% for the year. The Magnificent Seven, so to speak, the so-called seven companies are worth $21 trillion in market capitalization. I mean, how much larger is the question in 2026? No one wants to interrupt a good thing, I guess. That's the first rule in markets. But at some point, people will start to question that, isn't it?
Yep. Well, we're certainly in a position where additional gains there are climbing walls of worry about the underlying story. There's a lot about the U.S. story behind the Magnificent Seven that is concerning a lot of strategists and economists. So I think the early part of next year could be quite bumpy for U.S. markets.
Got that. Thank you very much for joining us, Cameroon. Appreciate your time here on CNBC TV18, and good speaking with you. Wishing you a very happy new year and all the best to you, your family, and your team. Thank you.
Thank you. To you and yours, too.
Okay, well, as I said, the big talking point last night, of course, was the Fed December minutes, essentially showing minutes of the meeting of the FOMC, which showed that the 25 basis point rate cut was a pretty close call. Here's CNBC's Steve Leisman on the minutes, and of course, are there any implications for future expectations of what the Fed will do? Over to Steve.
That the Fed, the 25 basis point rate cut, was maybe a closer call than it appeared from the vote, which was 9 in favor of the cut, 2 dissenting against it, and 1 for a 50 basis point cut. The minutes show that a few of those who voted for the cut said they could have supported no change at all, and some wanted to wait for more data. Remember, the government was still they were still getting data from the closed government period there. Inflation risk was seen tilted to the upside, labor market risk to the downside, and what you're going to hear now is a debate between those two sides. Some care more about inflation, others more about employment. Those supporting the cut said it was in line with forecasts for future lower inflation. Now, the committee did appear to agree on the need for future cuts. The debate was about the timing of future cuts. Most judged further rate cuts appropriate if inflation declined over time as expected. Some, however, wanted to keep rates unchanged, quote, for some time to assess the impact of recent cuts they'd already done. Others argued a move to a more neutral policy would help forestall what they were concerned about, a, quote, major deterioration in labor market conditions, to forestall that. Many saw a low probability that tariffs would lead to persistent inflation. That concern about tariffs was diminishing there. Several were concerned, however, that higher inflation would become entrenched. If it feels like I'm going back and forth, it's because that's the way the minutes read. Many expected tariff inflation to wane, but debated when and by how much. Some saw persistent price pressures, however, unrelated to tariffs. The majority of participants noted that inflation is above target for some time and had not moved closer, and some were concerned that the idea of the Fed not being at target would become entrenched and the commitment to the 2% target would be undermined by that. The labor market was seen continuing to soften, but stabilizing next year with appropriate policy. Now, this is a couple interesting facts that we keep talking about on CNBC. When you read the minutes, you see that the Fed itself is seeing this K-shaped economy with strong spending by higher income households, while lower income households are making, quote, adjustments for inflation. And a number were hopeful that higher productivity, possibly reflecting AI, could boost growth without inflation, however, also dampen job creation. So, Brian, I wish I could be more concise about how the committee felt, but the committee's feelings were literally all over the place.
All right. With that, let's tell you what are the interactions that are lined up on the show today. Coming up at 8:30, Devin Choksi of DR Choksi FinServ for some fundamental stock talk. 9 a.m., we will bring you a special discussion around insurance commissions with Nilesh Sathe and Thomas Devasya. At 9:20, Vineet Samre of DSP Mutual Fund will be our market master of the day. Give us an outlook for 2026 at 9:35 a.m. Management of Blue Star joins us to discuss the second half of this year and an outlook for FY27 and 2026 calendar, that is. And then a special discussion around lab-grown diamonds. We have, Ishwar Iyer and Prajay Maganlal as Titan enters the lab-grown space. And towards the end of the show, we will discuss data center boom coming in 2025 and what's ahead for 2026. Amit Sareen and Darshan Hiranandani join in. Take a short break. On the other side, a lot of stock-specific action to track today. We'll get to it in just a bit. But let's tell you, what are we looking at today? We have Tata Steel, JSW Steel, Bharat Forge, Taj GVK Hotels, Vedanta, Hinzink, Hubtown, New India Assurance, Premier Energies, all of them on our radar on the back of positive news flow. The single stock on our radar on account of negative news flow or likely to open in the red is Privi Specialty Chemicals. Welcome back. We end 2025. So this is the last, list of stocks that you need to watch out for just for today's trading session. And thereafter, come tomorrow, another new day, another new year. But the same list comes up for you with our team. This is CNBC-TV18's top stocks for the day and our team up for you. Let's start with Sudarshan. Sudarshan, metal stocks on our radar on account of the steel safeguard duty that has come by.
That's correct. So for the last few days, we are seeing a big uptick in all the metal stocks because tracking the global prices have been moving higher. But today, there is another positive news. Long pending safeguard duty has been announced by government. If you remember, in April of 2025, DGTR, that is Directorate General of Trade Remedies, which looks after the issue related to duties, had imposed 200-day duty, safeguard duty on imports of steel products. And that expired in early part of November. Now, government has come out with the announcement of safeguard duty for next 3 years, and that would be effective April of 2025 and will go on till April of 2028. So in the first year, that is from 2025 April to April 2026, the duty rate would be 12%. After that, next year, it would be 11.5%, and from April 2027 to April 2028, that duty will come down to 11%. So it will be taken positively for all the metal stocks, especially steel names like JSW Steel, Tata Steel, and all the other SAIL as well as JSPL. There is another positive news for Bharat Forge. Company has signed the defense order with Ministry of Defense, and that order is worth almost 1,662 crore. It's for the supply of CQB carbines, and the total volume would be almost 2.55 lakhs, and company will be executing that order over next 5 years. So both the stocks will be taken positively, and I'm going with green.
Okay, all right. So thanks very much for that. Well, Privi Specialty Chemicals is the next one we want to talk about. Actually, this is a name which we kind of indicated. Nimesh had highlighted in his chatter. We also had Parag Thakkar of Fort Capital yesterday talk about this one. But more on this. Vivek is here. Vivek, morning.
Well, that's right. As our colleague Nimesh had highlighted in his deep sheet chatter segment last afternoon, along expected lines, last evening a block deal was launched. We managed to access the term sheet. The promoter group entity by the name of Vivera Investment and Trading Private Limited is looking to sell up to 6.3% stake in the company. The route that they've chosen is the block deal route. The total size of this particular offer is close to 700 crore, and the floor price is at an over 11% discount to yesterday's close. So the floor price is between 2835 rupees to 2,850 rupees a share. Now, interestingly, there is also an upsize option which exists, although they have not given the size of the upsize option in case the demand is strong. We understand that the upsize option too may be exercised in order to further pair stake. Now, post this particular block deal, there is a lockup of 90 days on further stake sale or residual stake sale by the promoter. Going with the red on this particular name, but it'll be interesting to see how the stock reacts in case the demand is strong.
Take that point, Vivek. Thanks a lot for that. I'm looking at Taj GVK. Now, this is not unknown news, but this is just completed a development where promoter Shalini Bhupal has gone ahead and acquired 25.5% stake in the company at 370 rupees per share from Indian Hotels. This was a notification that was made to the exchanges on December 20th itself. So, the likely days of transaction was between December 29th and December 31st. Now, that has been completed on December 30th. The termination pact, which was between Blue Moon Trust, Moonshot Trust, Starlight Trust and the Indian Hotels Company, basically the promoters of Taj GVK and IHCL, as a result of this deal, stands to be terminated with fresh new deals to be made out here. So all in all, IHCL has exited from Taj GVK, whereas the GVK promoters now own this asset. From here on, how this business turns around is something that the street will be eyeing. In an otherwise strong sector, hospitality sector, this is the one stock which is available at a discount. But it's the commodities which are on our radar from overnight moves. Manisha joins in with that one. Manisha.
Well, thank you so much for that. And I'll focus on silver because we are headed to close 2025 with nearly 162% of gains. This is the best yearly gain since 1979 that silver seems to be putting out. Interestingly, this week has been very, very volatile. Usually not the case in the last week of the year. But this week itself, silver has seen a range of $84 of an all-time high on the higher side and then a sharp correction until 70.5 on the lower side as well. So that has been a $14 of a move that we have seen in case of silver. Well, if you look at this year, it has seen a gain from $29.5 to $84 an ounce. When you look at the Indian silver prices, we started this year with 87,000 rupees. It's trading at 2,55,000 rupees today. So that's the kind of gain that we have seen in silver. And that's exactly what has led to CME hiking margins for a second time in this week itself. So when you look at the overall margins, well, gold has seen 9%. Silver highest at 30%, platinum at 25%, and palladium at 22% as well. Now, interestingly, these margins will increase after the close of business on Wednesday. That is today. That is 31st of December. So you can well imagine the kind of moves that perhaps we would be looking at for the rest of this week as well. Margins are increased based on review of market volatility to ensure adequate collateral coverage. So while 31st December could be as volatile, so would be the 1st of January as well, even as most international markets are going to be shut. But whatever is going to be open and the access trade as well, you perhaps haven't seen the end of volatility when it comes to silver.
Absolutely. Manisha, makes sense. Thanks very much for that. So that's commodities, precious metals, and of course silver, which is very much in focus at this point in time. Okay, we've got some more stocks with news flow when Gaurav is joining us with that list. Gaurav, morning.
Well, good morning. First, let's talk about Uptown because board has now reapproved the amalgamation scheme. Remember, the amalgamation was between Distinct Realty, Amazonia Developers, Nitant Real Estate, and all these companies were going to amalgamate with Uptown. And now board has reapproved, and this will be subject to further regulatory approvals. Apart from that, let's also focus on New India Assurance today because the reason being, authorities, there was a GST demand from authorities worth 2,298 crores. Now, out of that, 2,187 crores have been dropped, and the final tax order is only worth 110 crores. So a huge relief is what we can say in terms of GST demand for the company. Lastly, let's also focus on premium energies because as per company's exchange filings, in third quarter of FY26 itself, they have received order worth 2,307 crores. Apart from that, they say that these orders will be executed between FY27 and FY28. Remember, today will be the day when the stock will also be traded in FNO segment. So definitely, let's watch out for all these stocks and see how they perform in a day-to-day.
All right, take that point on Premier Energies in particular, Gaurav. Thanks a lot for that. In fact, we thank our entire team. So let's give you a quick recap in case you just missed the conversation that we had with each and every one of our team on the stocks that they're watching. Stocks with positive news flow. We have Tata Steel, JSW Steel, Bharat Forge, Taj GVK Hotels, Vedanta, Hinzinc, Uptown, New India Assurance and Premier Energies on the positive side, and Privy Specialty, the only one with negative news flow. Let's move on now. Prime Minister Narendra Modi chaired a meeting with the economists at Niti Aayog for mission mode reforms across diverse sectors to sustain long-term growth to achieve the vision of Viksit Bharat by 2047. The theme of the interaction was Atmanirbharta and structural transformation as part of the roadmap for Viksit Bharat. Sources tell CNBC-TV18 that discussions focused on strategies to boost goods exports and diversify services exports, underscoring the need to strengthen India's global trade footprint. PM Modi also stressed on the stronger institutions and proactive infrastructure planning to meet future demand. Right, with that, we will take a short break. Come back on the other side. We have Devin Choksi, Managing Director at DR Choksi FinServ, for some fundamental stock talk.
Okay, well, welcome back. There's 30 minutes to go for the pre-open session at kickoff. Hormuz is here with the big movers from yesterday. Lots of, big single stock moves and some heavy volume action as well. Even though it's the end of the year, Hormuz is here with that list. Hormuz, over to you.
Good morning, Prashant. And yes, indeed. And it was that kind of a day when there were a lot of stock-specific activity in the broader markets and at very high volumes as well. And Intellect Design Arena was one such name, and the adverse broader market breadth was evident from the kind of fall that a lot of these broader market names saw yesterday, be it the likes of Intellect Design or Coromandel for that matter. For Intellect Design, it was the biggest single-day fall in nearly 2 months. The stock has declined in 5 out of the last 6 trading sessions. Now, the volumes yesterday were the highest in over a month. The fall came in at volumes that were 3x their 20-day average. So 7.5 lakh shares were traded. The 20-day average is 2 lakh shares. And out of those 7.5 lakh shares, the percentage of shares marked for delivery were the highest in 3 months. So almost 60% of those shares were marked for delivery with 4.6 lakh shares. And the 20-day average here is just 82,000. So almost 5x of the 20-day average was marked for delivery. The stock has not had a very good December so far. It's down around 14%. And as a result of this fall, the stock has also turned negative on a year-to-date basis, has Intellect Design. A name called Silver Touch Technologies was among the top movers in yesterday's trading session. It is a data solutions provider, and it has won a mandate from the Indian Navy. That is the announcement that it made, post which the stock was up in double digits yesterday. The biggest single day gain since November of 23. The volumes yesterday were the highest on record as well. The stock has a market cap of close to 1,300 crore rupees, and 16 lakh shares were traded yesterday. The 20-day average is just over a lakh, and out of those 16 lakh shares traded, 1.5 lakh were marked for delivery, the 20-day average being just around 50,000 shares. And it's had a fairly good year as well so far, up around 44% on a year-to-date basis. And lastly, Nalco. Metal stocks continue to remain in focus. But as we talk about the Hindustan Coppers and the Hindustan Zincs, Nalco has very quietly made its move towards an all-time high of its own. And the stock has gained in 3 out of the last 4 trading sessions. The volumes were the highest in nearly 2 months as well. It was the 6th straight session yesterday where more than 1 crore shares were traded in a single session. So 2.5 crore shares were traded yesterday on Nalco, a 20-day average of just over a crore. And out of those 2.5 crore shares, 96 lakh shares were marked for delivery compared to a 20-day average of around 46 lakh shares. The stock in the month of December itself is up around 20%. For the year, it's up 50%. And this is turning out to be the 3rd straight year of positive returns for Nalco.
All right, 3rd straight year of positive returns for Nalco, and decent gain that we saw in Hindalco as well, nearly 45% higher this year. What are the brokerages saying this morning? Are they even working on the last day of this calendar year? Well, they are. Sudarshan's read through a lot of those notes that have come by. Sudarshan, what are you picking up today?
So while market has been muted for the last few days, one stock, positive news does not seem to be stopping, and that is Shriram Finance. Over the last 3 months, this stock has gained as much as 60%. In the last 1 week since the day MUFG deal has been announced, the stock is up almost 15%. Yesterday, company had held analyst call, and in that it has given guidance for the next few years. And following that, brokerages have written notes on that. First one is Nomura. It maintains buy call with a target price of rupees 1,200 per share. It says company has given guidance for AUM growth, and that is of 20% for the next few years. Also, it has given guidance on ROA, and it believes that it can achieve the ROA of 3.6%. Jefferies maintains buy call, and it has increased target price to 1,145 per share. It says company expects AUM CAGR to accelerate to 18 to 20% over next 3 years, and AUM growth will be led by reduction in cost of funds that company had even announced or given in our interview last week. And it believes that cost of funds can reduce by as much as 100 basis points over next 2 years. Even it believes that NIM, that is net interest margin, can expand even if that cost of fund reduction can be passed on. Another note has come on Vatek Warburg. Motilal maintains buy call and target prices 1,900 per share. It says it remains constructive on its prospects as company is seeing order inflows on a regular basis and has a robust book-to-bill ratio of 4.6 times. One segment that it is positive on is ultra pure water segment, and it can be 3,500 crore opportunity for the company going forward.
Okay, all right, Sudarshan, got that. So we'll keep these stocks on our radar. Thank you very much for the details over there. Need to take a quick break. On the other side, Deven Choksi, Managing Director at DR Choksi FinServe, is going to join in with some fundamental stock talk. Welcome back. So let's get straight away to our fundamental expert of the morning. We have Deven Choksi joining in. Deven, thank you so much for being with us. Season's greetings to you, and hope you're all set to wind down 2025 on a very positive note. And, let me already wish you a very happy 26. So, let's start with actually some of the stocks. You've always liked financials, and I think that's where the maximum amount of easy money, so to speak, was made. This year, if you were in the right banks and NBFC stocks. So I'm going to start with that. Shriram Finance is still getting more upgrades, given what happened with the credit rating yesterday. Do you think despite a 50-60% kind of a move, there's still more upside in a stock like this?
Yes, okay, good morning and season greetings to you as well. And wish you all, I think, a happy new year in advance.
Thank you.
Well, I think the fuel is in tank as far as Shriram Finance is concerned. I think they have got a good amount of money already into the books. And that's what probably I like about the finance companies. When your cost of funds probably, I think, is supporting you on the liability side. And on the other side, when you are having the strength in the product, which they have, I believe that I think this combination was waiting to happen. And today, probably I think this is a good combination that I see as far as I think the growth is concerned. In my viewpoint, I think obviously it takes time for rolling out, I think, the larger part of the business activities. But given the size of the NBFC that they are today, and given the growth potential that we see, I think around 35,000 crore market cap, and I think the larger amount of growth potential, with every 4 years of doubling the balance sheet size, that's a guidance which has come from the company, which I believe is a good formula probably, I think, to look at the business. If one is invested for 3 to 4 years, I think naturally one is talking about, I think, doubling the size of the investment from that stage onwards. So yes, I think it has appreciated, agreed, but any correction in the price, which markets do give it times, I think it's a good opportunity to buy into likes of Shriram Finance, likes of Bajaj Finance. I think where probably you are seeing the continued growth in the business as far as I think the lending activity is concerned.
Okay, so that's a thumbs up on Shriram Finance and Bajaj Finance. Got that. The other interesting area of the market where stocks are off the peak, but the news flow still remains positive, is defense. Right? We've seen the Defense Acquisition Council announcement, 80,000 crores worth of orders they're procuring. Yesterday, Bharat Forge announced an order win. So in this space, is there any point in, from a portfolio perspective, not sort of a short-term trade, but is there any point in going back to stocks like whether it's a Bharat Forge or a Bharat Dynamics, anything in the defense pack?
Well, good part is that the roadmap is very clear as far as the defense is concerned. Government is definitely giving a good roadmap by way of spending money. Companies are getting businesses, definitely for sure. Look at the valuations. I think that is where probably I think the major fight is. This market is actually pricing in everything at least 2 to 3 years in advance. That's not very comfortable, frankly. Even though the business, I think, looks absolutely steady and convincing, but they cannot be growing the size beyond 15 to 20% rate of growth in a year. And if you are quoting the business at 65, 70 times price earning ratio, certainly I think you are going to be seeing a larger amount of sideways movement in the stock price. So yes, good profit, good business, good visibility for execution. But at the same time, the valuations are denying the entry into this kind of stocks. I think even though their long-term future is looking quite secure under the government's agenda, but again, valuation, I think one will have to be mindful about that aspect, I believe.
You know, one of the biggest disappointments of 2025 were the EMS players. Yes, they had seen a big rally in 2024 and the preceding years. The opportunity was supposed to be extremely large, but look at players like Dixon, look at, Keynes Tech, etc., down anywhere between 35 to 40%. For them to reach their 2024 prices once again, they will have to double in 2026. Do you think after nearly halving from the top, they make for a decent case?
Mangalam, I think the amount of opportunity that they have is phenomenal. Agreed. But most of these companies are putting at a price earning ratio of the valuations, I think, which is far more expensive. Even though you end up growing 35-40% in their books, and if you are still, I think, ahead of time, as far as 3 to 4 years of valuations already built into the price, there is no scope for any kind of negative news into the stock price. In my viewpoint, I think some of these stocks have corrected. They should be further correcting, if at all. I think they have to become attractive enough to buy into the portfolio. I think the fundamentals are not a question here. The valuation definitely remains a big concern and question. Unless the market returns with a momentum into mid cap and small caps particularly, I don't think that I think many of these companies, I think, which are quoting at still a fancy valuation, would probably see better times. They might probably, I think, see some amount of sideways movement for even a couple of quarters or maybe, I think, a year or so.
That's EMS. Definitely, it's been disappointing because stocks are well off their peak. That's been the story that kind of unfolded through 2025. The other space, which I mean, as EMS was cooling off towards the end of the year, metals were taking off. What a move in metal stocks they've been, right? And yesterday we've got the safeguard duty in, and that's, I think the steel sector was really waiting for that because the previous duty had expired somewhere in November, and now at least they have clarity for the next 1 to 2 years. How much does it help? And specifically, we'll talk, silver and non-ferrous in a bit, but on steel, what is your view, and would you look at adding any steel stocks to the portfolio?
Yes, I think metal as a commodity, we have been bullish for some time now. And I think largely the white metals, I think, where we had larger conviction, largely because of the fact that the kind of investment which is going into the power sector, the investment which is going into the data centers. I think this is where probably I think the conviction came from, and the directional call we took, I think, to invest into the white metals. The ferrous, that is the steel part, definitely we remain, I think, bullish on the prospect side for two reasons. One, on the other side, in the global market, I think the demand is expected to get built up over a period of time. We were hoping to see some amount of closure to the war-related affected areas and the reconstruction out there. Should that happen, then probably the demand for steel is going to go up, I think, for sure. Another area where probably I think the significant amount of investment is coming up now and in next 5 years is going to be in the area of data center. In fact, one of the report which I read, I think, which is suggesting that for the first time in the history, the more amount of money is being in the building of data centers vis-a-vis, I think, building the commercial workplaces. Now, if that kind of a situation is emerging in the next 5 years, probably I think the construction-led boom, I think, cannot be ruled out, largely because of the fact that infrastructure is getting built for the first time in the history. Given that, I think the total amount of capacity which is coming up in data center in the world of around 245 to 250 gigawatts from current 45 gigawatts, a 5 times growth, I believe that this kind of construction activity in the new age businesses could possibly drive a higher amount of commodity.
So, Devin, very quickly, in terms of stocks, I mean, just for viewers here and now, you said you like, the white metals. So, I'm guessing the play would be on aluminum and silver. So, what would it be? Would it be Hindustan Zinc? Would it be Hindalco, Nalco? So, in terms of stocks, how will you distill this down? The whole data center opportunity and the way metals can be a play on it.
Sure. I think the Vedanta looks, I think, relatively more safe, largely because the demerger is already happening. We like Vedanta in particular. Hindustan Zinc, of course, I think is a separate standalone company within Vedanta Group. But I think that is also another company which we continue to like. Though the stock price has moved up, any correction due to the volatile nature of the stock could be a buy opportunity as we see it. I think so. Copper is included in white metal. When we talk about white metal, I think we include copper for the electric, the spending on the power sector. So that's where probably I think we like Vedanta, we like Hindustan Copper, we like the Hindustan Zinc. Of course, Hindalco is there, but I think more importantly, these three companies, we feel that has a little more headroom at this point of time.
All right. Just hang in there, Devin. We'll come back to you for more stock talk as well. And let's listen into what Sapna has compiled on India's imports of Russian oil. It's actually hit a 3-month low. Russia still remains India's top oil supplier, but it's come down. According to some data that has come by, India imported about 1.1 million barrels per day in December, which is the lowest that we've seen since November 2022. So that's nearly a 3-year low. However, imports are expected to improve in 2026 as Russian intermediaries and traders are likely to make a bit of a comeback in the supply chain. Sapna Das joins in with the details on that one. Sapna.
Well, absolutely. This is an industry report which has been brought out by Kepler, so we need to be mindful of that. Having said that, the report very clearly indicates that there has been a sharp decline in the Russia crude oil import volume in the month of December. This is data up to 30th December. If you look at what it was in October, somewhere around 1.61 million barrels per day, which had shot up to around 1.84 MBD in November, just ahead of the sanctions kicking in. And then the impact of the sanctions is now visible. The volumes are down to around 1.14 as of 30th December. However, having said that, we need to be still mindful of the fact that Russia continues to be the top crude oil supplier to India. Around 25% of our imports are still sourced from that country. Having said that, we also need to be mindful of the fact that what happens now in 2026, well, as per the Kepler report, which indicates very clearly that the intermediaries, the Russian intermediaries, the trading partners, they are expected to take over in a big way, in the absence of the commercial presence of Rosneft, mainly for India, and broadly even Lukoil, so to say. So these intermediaries and trading partners are expected to keep those crude oil barrels coming into India, and this is likely to kind of rebound sometime Jan, Feb, March in 2026. That's what the Kepler report indicates clearly. And anyway, the bottom line is that 25% of our imports are still coming from Russia, despite the sharp decline that we are seeing in the month of December. Last but not the least, in terms of the top crude oil suppliers to India, well, not much of a change in the rankings there, apart from the Russian Federation. You have Iraq coming in a big way, and also the Saudis, followed by the United Arab Emirates, and US still continues to be the 5th largest crude oil supplier to India. The volumes had gone up basically in the month of October and November, but December there seems to be some bit of a decline. So more or less that ranking remains the same, and Russia continues to dominate the table.
Right, Russia continues to dominate the table, but we have seen a decline over the last few months on that one. Whether that returns or not is something that we will monitor, as we will also monitor developments around the India-US trade deal in 2026. But Deven, before we let you go, if you had to bet on one stock for 2026, we've seen many that did well. A lot of them did not do well at all. Shriram Transport, for one, was up 70%, and there's a nifty stock that we're talking about. And on the way down, we had Trent, which was down 40%. So if there was one stock that you had to just bet for 2026, what would that be?
So, Mangalam, I think without any hesitation, it would be Reliance, largely because of the fact that I think this particular company in next 2 years' time, 26 and 27, expected to list, I think, two of their strongest consumer-facing businesses, which is the Geo platform and the retail. Retail also includes the FMCG business, I think, which is now top 20,000 crore top line in the business, which is the fastest growing FMCG company in the country today. So we believe that these two companies getting separately listed, along with, I think, the rolling out of the renewable segment of the business, is a sufficient amount of tailwind for a company like Reliance to possibly move into the higher territory. Though I think we do agree that it is not going to be a crazy kind of an upside that one will see in front of a stock of Reliance. But even if I think in 2 years' time, we are talking about 50-60% kind of an upside from the current level, that would be, I think, a good level of entry point, I think, for someone to buy a solid stock in the portfolio for 26.
Okay, so Reliance gets a thumbs up from Deven. Deven, we'll leave it on that note for today and for this year. Thank you so much for all your advice. And thanks for being with us. Again, season's greetings. Wish you a very, very happy New Year. And we'll talk again soon.
Thank you, Surbi. Thank you all. And I wish you all the same.
Thank you. Well, let's take a break on that note. Come back on the other side and we will start getting the pre-opening rates. Also, we'll bring you a special discussion around insurance commissions with former members of IRDAI, Nilesh Sathe and Thomas Devasya. And of course, then we'll also connect with our technical experts, Sudarshan Sukhani and Mitesh Thakkar, for some trading ideas for the day.
All right, welcome back. You got what, 5 minutes to go for the pre-open session to kick off, and the opening bell, of course, is about 19 minutes away. Sudarshan Sukhani is with us, and so is Mitesh Thakkar. Gentlemen, good morning. Last Bazaar conversation for not last actually. We'll speak again at 9:10, but last before. First of all, how are you guys partying? Partying tonight? No partying. Sudarshan?
Yeah, good morning, and no partying.
No partying.
And 2025 has been very dull and subdued for the markets. I always thought we will get that Christmas rally, the Santa Claus rally, and that never came about.
Yeah.
It gives me the sense that maybe the beginning of next year would also, follow this pattern, subdued markets till we get some new cues. So that's the view for today and for the next month, maybe. Today specifically, we are in a narrow trading range. I think we all understand that. So for the Nifty to give any kind of signal, we need to cross 26,000 and close above it. That's when the buy signal comes. Till that happens, just avoid the range and do the stocks.
No, Sudarshan, I think Santa came, but he didn't bring the FPIs with him. That's the problem. Now, maybe he'll send them over in January, February. We'll see. But I take your point completely. I think what really pains is, forget comparing ourselves to the NASDAQ or the South Korean market and, so on and so forth. I was looking at the MSCI All World Index. Just pure MSCI All World. It doesn't get broader than that. Even that index is up 21, 22%. And, we've struggled with a 7, 8, 9% kind of a gain. But let's see. We live in hope. Mitesh, good morning. So how are you feeling about wrapping up this year and stepping into the new one? And what are you trading today?
Good morning, sir. I think, very clearly, I've been advocating that we'll be in range. And I think as the days are passing by, I think, the indicators are becoming flatter and flatter. So still no sign of a breakout or breakdown. So I believe that it'll be a market, when yesterday low is some kind of a pivot in the short term, though I think the bigger supports coming around 25,800, 780. But in case you get closer to yesterday's low, I think a long can be taken with a 30-point stop below that. And on the upside, 26,200 and then 26,400 are the two near-term target areas. So nothing big, but I think it can just be a market which can just amble around like this, like the way it's been doing for last about 3 to 4 weeks.
Any chance in exploring some small longs here around the 40-day where we are? Mitesh, no?
So Prashant, slightly lower, as I said, yesterday's low, which was around 25,870, 880. I think that's where, a trend line pivot is coming over there. I think that could be an area where you could take a long with this very tight 30, 40 point kind of a stop loss. And, if you get about 200 points on the upside, that will not be a bad trade.
Got that. What about trades, individual stocks? Sudarshan, you go first.
Okay. Tata Communications is a buy with a stop under 1775. Chola Finance, which we were talking about earlier 2 days ago, seems to have come back. That's a buying opportunity with a stop under 1670. Bsoft is an intraday short with a stop above 435. And Voltas is another intraday short with a stop above 1375. So buys and sells, focus on them, let the Nifty be.
Mitesh, what about you?
I have 3 buys to a sell. On the buying side is Bajaj Auto. I think a good breakout took place over here. The stock would head towards 9,500. Keep a stop below 9180. Canara Bank made a fresh swing high, so keep a stop at 150. Look for targets of 162. And a buy on NHPC, which is showing reversal from lower levels. So buy with a stop below 77 for targets of around 82. And one sell call, which is HCI Tech. It was a sell earlier as well. I think still showing signs of corrective pullback. So sell with a stop at 1635 for targets of 1575.
Okay. Just a very quick word, Mitesh, on these metal stocks that have moved like rockets. Hindustan Copper, even Hindustan Zinc to some extent. I mean, in last 2-3 days, look at Midhani, Mishra Dhatu. So there's a lot of fear of FOMO, for people who weren't on the trade. Is it too late to get on the metals trade now on some of these high flyers?
Yeah, I think, obviously, I think, after rally, you always have that problem of stock can always give a pullback. But what is, showing start of fresh up move is the ferrous name. So, if you missed Nalco or you've missed zinc and copper, I think Tata Steel sale still look good to me. Sale, in fact, yesterday was some kind of a trigger move, which could start a fresh uptrend. While there is a supply pivot at 145, I think eventually I'm looking for sale to head towards 158, 160. So it still gives you a good trading bet. Similarly, Tata Steel, I just discussed that as well. Tata Steel had a good breakout yesterday, looking at a first target of 185, 186, eventually 195.
They've all opened actually positive, yeah.
And they're fairly well bid as well so far. So let's see whether that, sustains as the market opens or not. A lakh shares in terms of volumes for the sale as well, settling higher with a gain of almost 2.5%. The fair amount of volumes backing that one too. But let's move on and speak about the insurance space, because the Secretary of the Department of Financial Services, the DFS Secretary, as we know, M. Nagaraju, had told CNBC-TV18 the IRDAI, or the insurance regulator, is set to come out with draft regulations on insurance commissions. Remember, the big surprise in the insurance amendment bill, which was cleared earlier this month, and CNBC-TV18 has been on top of that, was an enabling provision for the regulator to be able to regulate commissions that insurance companies pay. Let's listen in to what the DFS Secretary had to say.
The government is very keen to have to empower IRDA to have the oversight and also the authority to implement on the distribution costs, and also the power to regulate so that nobody is paying too much commissions. Because the complaint has been that some of the insurance companies too high costs, the agent commissions, and consequently the premiums are either premiums goes up or the ICR, increment capital ratio, is very low. So in both cases, the consumers will they actually suffer. So we wanted to give oversight legal power to the IRDA. So the government has given to that.
So there'll be certain rules and regulations that the regulator will be coming up
yes.
on this front particularly?
IRDA is expected to come out with draft regulations.
I think that's a senior-most official, government official, talking about insurance commissions, very much squarely on the government's radar in that sense. And it's a story that, we at CNBC-TV18, our colleague Yash, who looks at insurance, has been covering for many months now. And now very much part of the bill, and the DFS Secretary himself confirming that the regulator IRDAI is going to come up with draft regulations soon. Nilesh Sathi is former member IRDAI, and Thomas Devarsia is former member non-life at IRDAI. Gentlemen, welcome back. Good to have both of you back on the program. We've discussed this topic before. First up, season's greetings to both of you. And let me at the outset wish you, a happy, prosperous 2026. Mrs. Sathe, what did you make of the DFS Secretary and what he said, sir?
The first thing is there was no reason for now empowering IRDA. IRDA is already empowered because in the past there were commission regulations. If they had no authority, how did they release the commission regulations in the past? So it was already there. Now I do not know why it is being repeated again, but they were repealed in 2021 when they were subsumed in expense of management regulations. That is, in my opinion, a big mistake that IRDA has made. Let us candidly admit it.
You mean the repeal was a mistake?
Yes, of course, because now again they want
because for our viewers, essentially, so far basically they're saying that you got to break up the expenses of management. Overall cap will not do. We want to see what constitutes the expense of management and maybe have a cap on.
I understand.
Yeah, individual thing. Go on, sir. Sorry. Yeah.
That is precisely what was there. There were commission regulations which ensured a cap on commission and rewards. And there were expense of management regulations in the past, I'm saying. But in 2021, the commission regulations were withdrawn and they were subsumed in expense of management regulations with a hope that, like mutual fund, which has got only one ceiling of expense of management, the companies will be in a position to pay proper rate of commission. But it was observed that companies actually, when the commission regulations are not there, they started paying much more commission than what it was stipulated in the regulations. So again, it was necessary that it should be reintroduced. I will not say IRD had no power or authority.
But
they
more-
had
more
already.
clarity.
So it will be reintroduced, for which a draft regulation will be drafted. It will be made open for public for comments, and the due process will be followed within, in my opinion, at least 3 months take for a regulation to be in place.
Yeah.
So within 3-4 months, the commission regulation should be in place.
Which is why, sir, I think this is such a good time to have this conversation. And I'm sure there'll be many versions of this because it'll be open to public consultation. Yes. Industry will give its view and feedback. Yes. But I think most agree that this is an opportune time because financial markets are moving towards more and more transparency. So are products. Yeah. And again, I'll draw that parallel with mutual funds. And they've gone through that process as well, mutual funds, right? Where from the commission model moved from upfront to trail. Of course, MFs are a different product. But I think with evolution, we need more clarity and transparency, even with insurance commissions. So let me ask both of you for your recommendations or your recipe. Mr. Devasiya, if you could come in as well. What should be considered at a policy level now to make insurance commissions more rational and transparent?
Well, see, one of the underlying concepts of paying a commission is to reward the effort of procuring a contract, arranging it. It has to be reasonable. Now, reasonable is a very broad basket test. And that is where the whole game happens because there's a rush for the top line. So I would believe that even conceptually, and as Nilesh already said, IRDA was always having the power to look, oversee, and even understand line of business-wise commissions. There are even reports, standard reports that are there in the 2024 version of the reform regulations. What has been awaited was actually the intermediaries regulations, which I believe will now be much more refined with the support of the government, with the new leadership at the helm of IRDA, and it will be far more objective. But conceptually, if insurance, any particular product is a push product, obviously you pay a higher commission. If it is a pull product, you might even wonder whether commissions are required or mandated. I'll give you a classical example, motor third-party liability. That's compulsory. Health insurance, it's a necessity. So these are two issues where commissions need to be monitored or have to be actually, rationalized. But there are certain distribution models that are actually, negotiating and pulling out far higher commissions and rewards, and by whatever other method of, distribution.
So let's put some numbers, sir. Let's put some numbers to this. And that's the crux of the debate, right? Defining what is reasonable and rational in today's environment, in a fair, transparent marketplace where you have, digital platforms as well, selling products across the board.
Yes, they do sell. But the thing is, no one person can actually ascribe a number to it. It is actually a financial structuring. It's something to do with distribution strategy. It is a cost to the capital. It's a ratio of premium.
But do you
cannot actually just mandate a commission?
Mr.
Put a cap as it used to exist earlier. But even then, those caps were quite liberal at times, and for some, those caps were very low. There was no incentive for the agent.
So do you think, Mr.
What
Devasiya,
I'm saying is that one has to actually look at certain other distribution models that have been pulling out commissions, like bank assurance, like motor insurance providers, MISPs.
Okay.
So these are
fair enough. I get that. We're running into market opens. Apologies. Mr. Sathe, if I can ask you, what they come out from where we are, I mean, markets are bothered about the incremental change. Do you expect this to be a step change from how commissions are distributed? The quantum and how they're done, you think it'll be a big step change?
Yes, because earlier there was some ambiguity because commission regulations had commission plus rewards. I am of a view that whatever you are paying to a distributor, maybe under any name, should be considered as commission.
Got it.
And if you fix that and give a limit to it, that no payout to a distributor can exceed X percentage, it is very easy to identify who is paying more and also to have a check on if at all they are paying more.
Okay,
in the past we had commission regulations.
Correct.
Commission plus rewards. But that was ambiguous.
But I think this is what Mr. Devasiya was saying, that it's not the number, but basically how you structure it. But I think here now with these regulations, IRDA will step into all of that. So everything, I mean, you can't, a commission by any other name is still a commission. That's
Maybe that is how the 2024 regulation actually defines commission as commission by every name.
Yeah. Okay.
So that has been already addressed.
So, but it's not being obviously implemented, right? As Mr. Sati is
Enforcement, and I believe IRDA has got the necessary clarity and the backing, on a legal platform to now actually enforce, the management of commissions and effectively the management of all oversight of all distribution models.
Okay, so let's look at the other side of it then. Now that we've understood that commissions do need to go down, the implementation needs to be tighter, the definition of what commission is has to become a lot more, precise as to this is what commission is, and it can't be under any other name. But there are businesses which have been built around this, and some of them also listed on the exchanges with investors. And insurance as a product, we're still low penetration in the country. There is belief that we need to increase the penetration, increase the distribution of insurance, and this is something that the government has been speaking about as well. So do we run the risk of distribution being threatened with further tightening in commissions? I mean, is there a counter to this?
No, is it a tightening? I would see it as a rationalization of the entire structure or the approach to structuring commissions. And please appreciate, the insurers are even today left with the freedom to determine their commission levels based on the overall expense of management cap. But the logic here is, if the expense of management, let us say for a general insurance company is 30%, logically you should not expect any product or any line of business to go above 30, because that would mean that the company is printing money. So I think there's a lot of rationale that has to be built in. And effectively, IRDA expects that every insurer acts like a self-regulatory organization. So that supervision loads are less and commissions are fair and customers are seeing a better pricing, and effectively there are more customers onboarding.
Mr. Devasia, all of us have more questions, but we are running into market open, so we leave it there. Mr. Sate and Mr. Devasia, once again, thank you very much for joining us. Wishing both of you a very happy new year. Enjoy yourselves, and we'll speak in the new year. And this is not an issue which I think is going away. So those draft regulations will come, and we'll need your expertise to decipher them as and when they come. Thank you. Well, 9:10 calls. Sudarshan is with us, and so is Mitesh. Sudarshan, what do you have?
Chola Finance, buy Chola Finance with a stop under 1670.
Chola Finance. And Mitesh, what about you?
Buy on Bajaj Auto for targets of 95.
Okay, Bajaj Auto from Mitesh. So Chola and Bajaj are the two calls. Well, MCX has seen an upgrade, and a meaningful upgrade, some 15% bump up to earnings expectations for 26 and beyond. Sudarshan is here with exactly that. I mean, you just saw this flash, right? I mean, silver going all over the place. I mean, on MCX, volumes, of course, commodity volumes, really crazy last 6 months. But go on, Sud.
It's an interesting note. Do you know this is the first time that Morgan Stanley's target price is higher than MCX current market price? When MCX CMP used to be around 3,000 rupees, MS target was around 1,500. When CMP had gone to 5,000, its target had increased to 3,000. And when its CMP was 10,000, its target used to be around 6,000. So this is the first time that they have given the target which is higher than CMP. Now they have upgraded to equal weight and target. They have raised to 11,135 per share from earlier target of around 6,700. A main reason of increasing or upgrading to equal weight is the sharp surge in average daily transaction revenue that company has seen over the last 3 months. And because of that, they have raised EPS forecast by 15% for FY26, 20% for FY27, and 24% for FY28. Also, at current ADTR over FY27-28, it believes their stock may trade at 35 times PE, and that will be 5% premium to long-term average.
Okay, all right, so it got that. I think we're just a couple of seconds away from opening. By the way, Mitesh called it spot on. Today's trade is really ferrous all the way. Thanks to that safeguard duty, all your big steel stocks, JSW Steel, SAIL, Tata Steel, all of them up between 2 to 4%. So that's a clear morning trade. Let's see if it has enough volumes, but the price action surely is there.
Absolutely. Well, I think we've got market open coming up in a couple of seconds, and we'll stay with prices. And pick it up from there. So insurance in focus, but I mean, I think individually MCX, as Sudarshan pointed out, and a bunch more. So opening rates about 0.25% higher, so much better start compared to yesterday, 26,025. The Nifty Bank is up about 0.1%, 0.2, I think, or so. The sensex up a quarter. Small cap index is up a third, and I think the mid cap index will come up on your screen with price changes. Well, about 1/3% higher on the mid cap index coming through. So that's the opening rates. We are above 26,000, and I think, of course, we are, after breaching the 40-day exponential, we are holding above it, and I think we should be closer to the 20-day as well for the Nifty and for the Nifty Bank as well. Steel stocks up there, so JSW Steel and Tata Steel, but you got 40 out of the 50 names higher. TCS is on the other side, Mahindra and Indigo come up as well. So it's a 70-point start, higher start for the Nifty. Surbhi.
Yeah, indeed, we are above both the 50-day and the 20-day now at 26,000. Nifty's managed to climb back. And steel is the big morning trade, like I pointed out earlier. So JSW Steel, after the races, 3% up. Tata Steel up about 2%. Remember, the safeguard duty has come back at the original level, at least for the next 1 odd year, or next couple of months at least, and then it gradually tapers down. But that's a sigh of relief for the domestic steel manufacturers. BEL is the other one that's up and about. Actually, speaking of BEL, let's pull up Bharat Forge because they won an order for these carbines yesterday, over 1,600 crores of an order. There's some green on Bharat Forge as well. Adani Ports, Jio Financial, Adani Enterprises, Bajaj Finserv. So it's pretty mixed. Some of the large cap banks are doing okay. Axis and Kotak, for instance, both have gains of about 0.5% each. Reliance is a nice support for the bulls, 0.5% up. Lever is supporting, 0.5% higher. So all in all, it's a pretty decent looking screen. 75 up on the Nifty. So getting ready to welcome in 2026 in style, it would seem. On the downside, actually, you just have a couple of auto stocks. Eicher Motor, M&M losing some ground. There's also Bharti Airtel, which is lower by about 0.5%. Other than that, it's all looking good. And we've got 3/4 of a century on the board for the Nifty. Mangalam.
Well, 3/4 of a century on the board for Nifty, doing extremely well. The broader market is doing well too. As one would imagine, global spirits on the last day of the year, a lot of these spirit names are doing well. So global spirits is up around 5%. We've also seen, as it is the wont of the start of a new year, Zydus Wellness is up 2.5%. There has been a Motilal Oswal initiating coverage on the company. Remember, this company offers a lot of no sugar substitutes or low fat, high functional products. Typically, people make New Year's resolutions to that extent as well. So the stock doing fairly well this morning. Though we've seen some bit of a decline in Hindustan Copper, though I believe that, at lower levels, Hindustan Copper has seen purchase and recovers from the low. So I'll be interested in seeing how that pans out as we move forward. HFCL is up around 3.5%. SAIL continues to do well. We've seen some decline in PB Fintech. It's not been a good week for them, down 3.5% for that stock. Federal Bank is the other one, which is lower today at the open. And 361 WAM is another stock which is down by about 1%. All in all, more stocks advancing than the number of stocks which are declining.
Okay, I think 1670 stocks are higher and about 650 stocks are lower. This is still, early days, but that is what's coming through. What else, right? And the KPI Green, maybe a few other names, is coming up with large volumes. It's up 5% right now, KPI Green. Orient Tech was a big mover yesterday. I think it was circuit up yesterday, Orient Tech. It's up another 7%. There is BSC, which is coming up with about a 2% pop, so 26.30. I'm just not looking at price change, but price along with volume. Samman Capital is coming up with about a 2.5% bump, so 144. There is Deepak Fertilizer. Yesterday, a few of these fertilizer companies were bouncing around 4% on Deepak Fertilizer. HEG is up about 2%. There is, I think you can go down the list, but volumes will start to fade. Viatech Vabag, I thought there was a brokerage call on this one, 2.5% higher, but volumes are not very large or anything. Shakti Pumps has fallen quite a bit from the highs, 2% on this one. Solar Industries is up about 2% or so as well. So that's the sort of overall picture, overall perspective. And I think you guys mentioned the Privy Specialty name, right?
Trade, yeah.
13% lower. Of course, that block's gone through. Hindustan Copper is down. Hindustan Zinc is down. And of course, all these silver ETFs are down about 1.5%, 2% as well. But that's basically just swinging around with respect to what's happening to the underlying commodity.
I'm very curious to know if there are users of steel which get impacted by the higher price of steel. We are looking at some of these metal stocks do extremely well. So there's JSW Steel, Tata Steel, but on the opposite side we do have Eicher Motors, which is lower, M&M, which is lower, auto stocks. So I don't know whether some of these auto stocks which are consumers of flat steel could get impacted on the negative side.
By the way, Mangalam, tomorrow we'll have to do some pull this up, and we'll do it. There's EU has this green steel regulation.
Yeah.
So steel which is made by greener manner, well, not renewables completely.
Yeah.
That goes into effect tomorrow. So there is. I remember reading that we don't export too much steel. I mean, most of the steel is consumed here in India, but for those like Tata Steel, etc., which have operations overseas. Exports into the EU region, perhaps we'll have to see. We'll get some perspective on this, because this is, of course, a broader issue. A lot of steel factories in China have been converting this, going in preparation, because they're large exporters into the EU, etc. as well. So that's the other thing.
By virtue of my conversations with Sonal, who tracks the climate space very closely, she's been saying that this will be a bit of a concern from an industrial standpoint as well. Yeah.
I just want to point out that one of the reasons why you're seeing these big outsized moves on steel counters here today is one, that there seems to be an immediate shift. So from the non-ferrous trade, people are quickly hopping onto the ferrous trade. And the other is that the safeguard duties that have been announced, it's not only for 2-3 months. Now there's a very clear roadmap. So the duty stays at 12% up until the end of the current fiscal, that's 31st of March, 2026. The next entire year, it stays at 11.5%, so tapers down from 12% to 11.5%. And then the following fiscal, FY28, it comes down to 11%. So there's a lot of clarity now in terms of how the duties are going to play out. Of course, government could come out with tweaks as and when it feels necessary. But for the time being, this seems to be the indication. So fair amount of clarity on steel names. But I think we have our next guest now joining in.
Yeah, Vineet Sambre is Head of Equities at DSP Mutual Fund. Vineet, season's greetings, and let me say this at the outset instead of the end. Happy New Year 2026.
Wish you the same, Prashant, and the team.
Vineet, 25 was not a great year here in India, but it's been a great year for many other markets around the world. Hope is that things will turn for the better here. While we wait for triggers and things to happen, do you think time correction wise and price correction wise, valuations are now reasonable, or you think that still is the number one headwind in that sense? What's your sense overall, Vineet?
So I think, Prashant, this is I think you've hit the most important aspect, which is the market's valuation. And I feel that, the headwinds which we faced last year, 2025, was very unusual. In a way, we had all the global uncertainties. We had, we ourselves going through a bit of a slowdown where corporate earnings actually did hit a low patch. But despite that, we've not seen, if we just look at the aggregate valuation at the Nifty level, we've not seen as much correction as we faced the headwinds as far as the macroeconomy is concerned. And while the macroeconomic economy now looks okay with whatever the government has done in terms of the reforms, the interest rate coming down, maybe the corporate earnings also should start gradually limping up. But in terms of the valuations, I don't see that there is a great margin of safety to start maybe looking at in a big way. There are two ways to think. Either the valuations become really reasonable for one to start looking at from absolute investments perspective, or maybe there is a clarity in terms of the earnings catching up momentum. So I think these two need to get sorted before we see clear directions for the market, at least for the 2026 is what I feel.
What are appearing as attractive bets right now for the next year?
So, I think the bets doesn't change. The year has changed, but I think from the overall, if I just take the top-down perspective, interest rate beneficiaries are the ones which comes to the top of my mind. And from that perspective, the lending institutions and more prominently the NBFCs is something which will see the benefits of the interest cost. And that's where one pocket which I think should do well. Beyond that, I would imagine that one has to look at some cycle recovery. I was hoping for a consumer-oriented beneficiaries as well because of the reforms, the disposable income going up. But consumer sector as such is actually going through a lot of disruptions. So one has to be very, very selective and careful because what used to be very dominant franchisees across the board, I think they are facing a lot of threats, both in terms of competition or in terms of the online presence. So I think there one has to be more selective. In terms of the cycle recovery, I would say power sector went through unusual slowdown because of the extended monsoon. So there, I believe one can see a turnaround. And one more space which I am actually positive on is the agrochemical space, because that's one space which has again got affected because of the unusual season. And the stocks are actually trading quite cheap in a way as compared to the history. So I think that's one space to sort of focus on.
Vineet, hi. Great to be speaking with you, and season's greetings to you and your team and all at home. Now, you're someone who's been a specialist in picking stocks in a debate which rages in this market between whether there is alpha or no alpha. Is it the time to go passive? You're someone who's excelled at picking those hidden gems and those opportunities, right? So therefore, my first question to you is this. Whether 2026 will see a pivot back to the mid and small cap market or not, because if I was looking at the fund positioning at your end, so if you look at the DSP Flexi Cap, where the fund manager has full freedom to move on whichever side, you guys are still more large cap oriented. 60% of that fund is large cap, 40% is mid and small. So therefore, are you entering 26 with the same sense of caution that it's going to be a large cap driven market?
See, actually, while these are the debates which keeps happening, but at the time of building portfolios, it all finally boils down to what companies are eventually going to deliver outperformance. And from that perspective, the differentiation between the large, mid, and small doesn't remain as much as we think from the top-down perspective. But broadly, if I have to think, 1 or 2 years can be really differentiating in terms of whether large caps outperforms or mid caps, small caps outperforms. But if one actually just pulls the period for a longer term, I believe the small and mid caps in India, they have good potential to keep outperforming the large caps. Now, while I say that, last year was not great relatively for the small caps as compared to the large caps. Maybe this year also it could underperform, but I'm saying that I see a lot of opportunities, like you said, by looking at the companies bottom up, that the companies will do really well over the course of next few years, and that's where the confidence of the small and mid caps doing well. So I think one has to maybe be rational around how to balance, because the timelines is something which is very difficult to predict.
Let me also ask you a slightly more academic conversation this morning, but let me just pick your brain on this. The other trend that at least I've noticed as someone reporting on the market for so many years is that mid and small cap investing has also become very trend oriented. When the trend is in your favor and when that particular theme or sector is the flavor of the market, stock prices can go through the roof. I mean, multiples can expand to 100 PE at the blink of an eye, right? And then when the sector starts derating in a matter of sometimes months, if even not even years, then the drawdowns are equally sharp. I mean, EMS is one example of it. We've had so many other renewables as a theme. When the theme is right, stocks will run, then they'll crash. Same for these platform companies. So is this the nature of the beast? Is this the kind of high volatility that you just have to live with? You have to trade the trends and time them right if you want to invest in mid caps and small caps.
So I think I still believe that in the end, long-term fundamentals will matter. But I think you're right. We are also observing that the last few years has been very different. And there are two components to it out here. So one is that the classification, especially as far as the mid caps are concerned, you have those 150 stocks to sort of work with. Now there are the diversified funds which are also looking at the mid caps as a universe. Mid caps themselves are looking at the mid cap as a universe, and at the same time we had this new set of investors who are still, this financialization of saving which is taking place is pumping in so much money into the funds. So I think there's a chase for the near-term momentum, and wherever the earnings are seems like inflecting upwards or downwards at both sides. that's where we are seeing the flows also actually moving up and down. And I think you can maybe do some small research whenever the stocks move out of the mid cap and gets into large cap. That's where the the rally halts in a way, despite maybe the earnings performance being there. So which is also a factor where the fund flow also matters a lot. So I think these momentum bit is actually going to be part and parcel of the short term trades maybe, and the markets are more right now aligned to those moves. But I think in the long term, eventually what will matter is that durable earnings and such the competitive business are going to sort of outperform is still the belief I have.
Yeah, I mean, and forget mid and small caps. That's happened in the large cap space as well, right? Trent would be an example of when the market loves you, it really loves you. When it wants to forget you, well, it just moves on. But I guess that's the nature of the beast, and that's
that's life.
Yeah, at least in the Indian context, I think because of the demand-supply mismatch, like Vineet is also saying, it's something that we just have to learn to live with.
Yeah, and it's also a function. I mean, there's no direct correlation here, but there's perhaps could also be a function of the way hype is generated on social media, or all forms of conversations that people have, because every aspect of conversation is magnified because of more people speaking about it, and then timelines are narrowed as well. But let's go back to the basics. Vineet, you've liked the IT spaces. It's a contra buy for you, so to say. You've been a contra positive here. Some of the mid-cap names, and then very recently we had that big deal with Coforge as well. What is your thesis on the IT space, and if you can say something like a deal that Coforge did?
See, first of all, I continue with my sort of positive view, and it's more also linked to where the valuations are for the sector as compared to most parts of the market. We've seen that the sector is actually pricing in some of the big risks which we are talking about. Risk being the uncertain environment, risk being the poor deal flow, risk being the AI trade which is happening globally. So now I believe that these risks are well priced in the stocks. I mean, last year 2025 the IT sector has underperformed. From that perspective, any change in the outlook globally can lead to a turn in the sentiments, and also the outcomes could be good. As far as the likes of Coforge is concerned, I think broadly for the IT sector, companies will have to go for investing into new technologies. They will have to adopt. Otherwise, I think I see a risk of companies also actually shrinking in terms of their overall outlook going forward. So I think companies which are actually taking that call, I would want to sort of give them the benefit of doubt. Only thing is that they have to be rational in terms of their pricing, what they are paying. They have to also, if somebody is paying a higher price like what Coforge did, I think they have to justify by way of showing high growth going forward, and which I think the management there has demonstrated in the past, which is where we still want to give them the benefit of doubt. Now, acquisitions generally have not been great. If you look at the history, 70% of the acquisitions fail. So that is there, and hence I think the companies will have to be extremely careful in terms of their due diligence and go for it. But I think there's no escape. They will have to invest. Just giving money out as dividend will not serve the purpose in the long term, is what I feel.
Again, Vineet, just going back and looking at the portfolios, obviously you love banks and financials. That forms a large chunk of many of the DSP funds. There's IT that we've discussed. And actually, at least in the flexi cap, I see less exposure to capital markets. So let's actually talk about financials, Vineet. How much of the good news and the excitement, pickup in credit growth, improvement in margins, how much of that is already priced in? Because financial stocks have rallied 15% to 50% in some cases this year.
By the way, if you just look at the 2025 returns, ICICI Bank has not given any return. I mean, it has been flat. So I think all what we speak about the credit environment changing, I think the large banks have really not outperformed as much, and maybe there's space out there to see not very high growth, but at least linked to the credit growth in the system this year, and maybe the asset quality benefit should also be there for the banks. But I think beyond that, I feel that the banks which are, or the NBFCs which are actually trading at let's say slightly higher valuations, it's on the back of high growth. Now, as I see the environment, I believe the lower cost of funds should benefit the NBFCs more. We had, the current event where the foreign investors have also invested in the NBFCs. I believe that they will continue to show high growth. They will be beneficiary of low cost of funds, and hence the premium valuation should sustain out there. So I think a combination of maybe a large bank, a couple of NBFCs, sectors where one could see inflection going forward. I mean, NBFCs focusing on those. I think it's a good way to look at the financials in that format.
All right, it will be very interesting to see if there is any change in the competitive dynamic out there with the kind of FII flow that has come in the large NBFCs as well. One of them which has been surging right now is Shriram Finance, up now 71% in this year itself. Vineet, hang in there. We'll ask you your views on some of the commodities space as well if you have a thought here. Sudarshan joins in on steel safeguard duty because that's the big story of this morning. JSW Steel now around 4.5% higher. We've seen a big move across the steel space. Sudarshan, it's definitely a positive and a big one at that.
It's come as a booster for the sector which was already in the focus over the last few days, tracking global metal prices, and that have been moving higher. If you remember, in the April of 2025, DGTR, that is Directorate General of Trade Remedies, had announced temporary safeguard duty, and that was applicable for 200 days. And it expired in the early part of November. Now, finally, government has come out and imposed safeguard duty to protect the domestic industry, which was facing basically from the imports, higher imports from China, Vietnam, and other countries. Now, this safeguard duty would be applicable for next 3 years. And it will be effective from 21st of April 2025. So in the first year, from April 2025 to April 2026, the duty is of 12%. After April 2026 to April 2027, that duty comes down to 11.5%, and from 2027 to 2028, that comes down to 11%. So overall, after the temporary safeguard duty for 200 days, now this duty is being imposed over 3 years. That's the reason you are seeing a big move in all the metal names, especially steel companies. Top Nifty gainers, JSW Steel, Tata Steel, JSW Steel up more than 4%. Similar move is being seen even in the mid-cap names.
All right, Sudarshan, thanks a lot for that. So big moves on all the steel names. I'm not sure, Vineet, you actively invest in commodity cycles because that's not your typical style. But do you think because of higher input prices, some of the users, you've been liking autos, auto ancillaries, etc., do they stand to get impacted negatively?
Yes, surely I think they will be impacted because both the ferrous, non-ferrous commodity prices have been going up. But I would continue with my positive view around the auto anchs because I believe the changes which are taking place in the auto sector is significant, and I think that auto anchs are the best way to play that. And auto anchs are just not a way to play what's happening in the auto sector, but if you look at a few of the companies, they've also started getting into the adjacent categories, and that is linked to their engineering skills. So, some of the companies are now, tied up with Apple to be supplying to the Apple ecosystem, and that can be a very big opportunity going forward. So, I believe overall auto anchs, the next course of 3-4 years should be a good proposition. And given the fact that even within the auto sector, this whole transition from ICE to EV, if that actually catches up, a lot of companies have also align themselves to serve both the categories in a way. So I see a lot of change in the sector and these companies to be beneficiary out of that. Now, this commodity pricing could be near-term headwinds for a while, but given the opportunity and the growth prospects, I would continue to have a positive out there.
Okay. All right, Vineet, we'll wind up the conversation on that note. Thank you so much for joining in. And once again, wish you and your team, everybody at home, a very, very happy New Year. Thank you for joining. Well, with that, let's move on and put the spotlight on Blue Star. That's the next company on our radar. Now, it's been a tough year for the room air conditioning business, overall for the air conditioning business, because of unseasonal rain for the better part of 2025. In fact, this is something that Blue Star has already acknowledged during its several quarterly calls, saying that in all probability, FY26 is going to be a flat year, but this is not a structural issue. It's a cyclical factor that's played out this year. So let's understand what the latest trends are like. We have with us Mr. B. Thiagarajan, MD of Blue Star, joining in. Mr. Thiagarajan, thanks so much for being with us. Season's greetings to you. When I say season's greetings, I don't know how it sounds. I mean, when I talk to a company in the business of air conditioning, right? Because the season was really not in your favor this time around. We have a couple of points. I'll just put that on the board for our viewers as well to define the conversation. Obviously, we want to figure out where the whole, air conditioning cycle is going. Is there hope of a better 2026? So we want to understand what the inventory position is like. And really, in terms of the various segments of the company beyond unitary cooling products, how the other segments are likely to fare. So, Mr. Tyagarajan, I come back to the season's greetings and hopefully wishing for better seasons ahead for the air conditioning industry as well. But really tell us, let's pick up from our last conversation where you told us, and you're always as candid, that it's very difficult for the second half to make up for the losses that we've seen in the first half. So are you still at that same level of guidance at best case in terms of top line, this will be a flat year? Or has there been some growth post the GST cuts?
Good morning, Shilpi. It is always a pleasure interacting with you. Season's greetings to you, your audience, your colleagues in CNBC-TV18. Never in the past 5 years, it was a COVID year. One wanted the year to end faster. So I am looking forward to this 2025 ending as early as possible, a few hours away. It was a bad year. It was the poor summer season. There was a GST blackout and inventory pileup. And the good news is November, December has been good. You could see the movement of goods both in primary and secondary sales. And one look forward to the summer season, which should set in end of February. So that's about the room air conditioner market. And even if it is going to be flat or, let's say -5% compared with the previous year, we are comparing with a year which was an exceptional year, FY 25. But CAGR, if you look at it, even if it is FY 20 to 25, FY 23 to 25, it is above 19%. So I'm not worried about the demand that is going to be there and the prospects for the industry.
Yeah.
It is that it was a bad year.
So actually, I mean, what you're saying, and I don't know if you meant that for Blue Star or for the industry, if you're saying that the room AC business will end 5% lower, that's actually better than what you had said earlier. Earlier you said it could be as low as 15% this year. That's for Blue Star, right?
No, I'm talking about the industry growth. I'm talking again end March 2026. There is a possibility that it ends with -5 or flat. It all depends on how the summer demand is going to be. But equally, as I mentioned, that it can be even -10%. We don't know. But the important point I'm saying is that it is compared with the FY 25, which was an exceptional year. Unprecedented growth was there, over 35% for the full year. Summer season alone was over 55%. So therefore, the CAGR is maintained. And given that never in the past two summer seasons were washout, I think it will go on well. So I look forward to FY 27 in a big way, or the summer season 2026 to be a good season.
Mr. Tyagarajan, good morning and the season's greetings. I'm going to talk about something which is like forecasting the market, forecasting the weather, which is our colleague Manisha, who has a close eye on all things weather and commodities, tells us that this is a La Nina phase. Now, I'm no expert, but broadly what it suggests is that it's basically cooler temperatures, cooler winter, and maybe extending all the way into April, June of next year. Slightly more cooler temperatures. Isn't that the sort of peak season with regards to build out of for the AC industry to meet that summer demand? So would you expect these conditions to affect FY 27 numbers as well? I mean, if this were to persist, what's your sense?
I have talked about this. It's not the real temperature that matters. It is the humidity. And in it, even if it is above 35 degrees centigrade, one would like to be in an air-conditioned environment. And you are used to air conditioning in a metro railway or a bus or a car or in the office or in the shopping mall, cinema theater, restaurant. So this category has to grow. It is, we are talking about a 35,000 to 40,000 rupee product, and the penetration levels are lower. So I don't think, it has to be a long summer of 45 degree plus, etc. We have seen in the past, all that it requires is 2 to 3 weeks of discomfort.
High humidity. Just to understand that from an inventory perspective as well, you said that inventory has started getting cleared up in this November-December period. So typically, what is a normal inventory cycle or a normal inventory level for you? And as opposed to that, where is the situation now? What is the situation now?
From a manufacturer point of view, 45 days would be an ideal inventory, given that it is an Indian manufacturing ecosystem and the component ecosystem is good now compared with what it was 4 or 5 years ago. That in Blue Star's case, it was crossing 60 days. And I think by end of December, we should get there to 45-day kind of inventory. In any case, there is a energy label change which will come into effect midnight today, which means you have to either relabel the product or you have to liquidate that. But in the market, my estimate is that till around end of February, there will be enough inventory available.
Right.
If the summer sets in, then the new energy label products should begin to move.
Mr. Tyagarajan, we've spoken a lot about air conditioners and how this year has been terrible for them. But one category, which was the category of this year in the consumer durable space, was air purifiers, because we saw a big jump in air purifier sales, as we saw a big jump in or deterioration in the quality of air as well. How much does that account for in your overall pie this year, and how do you expect the dynamics of that category to change over the next, say, 3 to 5 years? How big is the opportunity?
Good morning, Mangalam. It is negligible. The total market size is less than 500 crores. And it's basically two cities, Delhi followed by Mumbai. And there is all kinds of products exist there. There is no certification of a product that how do you know this air purifier is going to be doing what it is supposed to do. Starting from some 6,000 rupee onwards till 50,000 rupees air purifiers are getting sold. It's not going to make a big difference at all. The room air conditioner is the largest in a complete air conditioner. It is much larger than even commercial air conditioner.
Right. And finally, in terms of competition and market share, well, the industry was under pressure all of this year. Have you held on to your market share? And what is it that you're targeting for the next year?
We have improved our market share. While the growth has not been there, we have improved our market share. And I think as the market begins to grow again, you will see intense competition, and I think that is inevitable. You need to compete. You have to deliver growth. You have to deliver the margins, and it is going to be intense competition. There is no doubt about it at all.
Can you give us an FY27 outlook in terms of revenue, margins, and market share that you're targeting before we let you go?
So I'm talking again about room air conditioner. If you compare with the FY26, it will be exceptional, but that is not the way to compare. Internally, we would like to compare with the FY25. And over FY25, if 15% growth one delivers, it will be exceptional. And the margin should get back to margin outlook of 8 to 8.5% in room air conditioner. That should happen. And as you are aware, the B2B products, whether it is projects or commercial air conditioning, it was again a bad year. The order inflows were not that great. Only the factories and data center segments supported us. The large projects, there have been inordinate delay in causing concern. So therefore, FI26 should be good for that business also. That's what I'm hoping.
All right, FI27, 15% growth over FI25 with margins between 8 to 8.5% for the room air conditioner business would be something that you are targeting. Let's see whether the weather supports or not. You are holding on to your market share.
One thing, Mangalam, is absolutely clear. And I just want to say that, Mr. Tyagarajan, I think if you look at long-range forecast, right, number one demand for energy is cooling.
Yes.
I mean, there's no doubt. I mean, in India, globally, I mean, I think air conditioners play an important role. But since we are doing this and having this conversation, slightly near-term focus with regards to hotter, cooler summer, etc. matter. But that's in the very near term. Thank you very much, Mr. Tyagarajan. Really appreciate your time and wishing you a very happy and prosperous 26, sir.
Same to you, Prashant. All the best. Thank you.
Okay, we'll take a quick commercial break here and we'll come back and we've got an interesting discussion lined up on the jewelry space and the rise of the lab-grown diamond industry. One of the largest jewelry organized jewelry player in the country now, stepping up their game there. So it's an interesting discussion with two players in the space coming up on the other side. Stay tuned.
Well, it's been a good start to this ultimate session of 2025. The consumer stocks actually doing well. We have HUL, which has moved higher, Asian Paints is higher, and none higher than Titan, which has actually moved to the highest point of trade after, it's announced. In this month itself, the stock's done well. It's closer to its record high than ever before. It's over 4,000 rupees. It's announced its foray into lab-grown diamond after a very long time. Here on CNBC-TV18, we've been asking the management for many years, and they've said that they're looking at this market very closely, but they didn't make any plans public until December 29th, where they launched their first store, Beyond, in Mumbai. Managing Director Ajay Chawla told CNBC-TV18 exclusively that he expects to close this financial year with a few more Beyond stores. And how will this impact other players in the industry? How will this impact the industry itself? We're joined by Ishwar Iyer, who's the CFO at International Gemological Institute. Basically, this is a company that certifies lab-grown diamonds, the leader out there. And Prajay Maganlal, who's the CEO at Elevate Lab Diamonds as well. Prajay, let's ask you, up until now, lab-grown diamonds were looked at as a child which wasn't loved as much by the parents, but loved a lot by their friends. So consumers loved lab-grown diamonds, but the large players were still looking at it with some sort of skepticism or something that may eat into their own overall business as well. Now with Titan actually finally shaking its hands with that child and saying that we're part of this, we're in this together. They've opened this, and the largest player, the most trustworthy player enters this space. Do you think it gives it a little more legitimacy than what it earlier had? And what does this do to the industry according to you?
Well, Titan entering the industry, right, provides institutional validity. It tells us that the market has now reached the stage of maturity where big players are getting involved. And Titan has actually been giving signs that they're looking at this industry pretty closely over the last 1 year. Malabar is doing the same. Number of other big players are doing the same. So I see this moving forward as a market of segmentation and choice, not really of disruption. There's absolutely going to be space for both natural and lab-grown, and Titan getting into it just proves that.
All right. And what does that mean for your volumes? Ishwar, I have to ask you that in terms of tests. Have you, will you be participating in testing some of these LGDs for Titan, or will they buy LGDs from people who you've tested for already? What does that do to a business like yours?
Well, good morning and thanks for having me on the show. So of course, we've been talking about this over the last 3-4 quarters in our analyst call, etc. I think we continue to maintain that IGI will be certifying diamonds. So we are a neutral body. We are a third-party independent grading body. So, and we've also mentioned this in the past that the lab-grown segment is the new entrant for the industry. And the lab-grown jewelry segment is starting to see some serious growth in India. I think in line with those industry trends, I think there are a lot of larger players now coming into the field. As we've spoken in the past, I think the lab-grown segment was first adopted by the US consumers. And as the Indian consumers also come into the fray, I think we just at the start of a big, very, very big cycle as far as the lab-grown jewelry demand is concerned, as far as the Indian market is concerned. So obviously, IGI is well positioned today to manage this diverse portfolio of rating services that we provide.
Right. So, just go back to what we were speaking with Prajay. Prajay, what is the total sales of LGDs in India right now as per you? And with Titan entering it, the mature market, do you think it can accelerate the demand? And what does that do to prices of natural diamonds?
Sure. So just a few numbers, right? Today, diamond jewelry makes up about 10% of the Indian jewelry market. LGDs within that space, till just a few years back, were about just 1% of that market. Today, LGDs have moved to about 3%. So they're roughly around $300 to $400 million is the lab-grown diamond jewelry industry here. With Titan entering the market and with other larger players entering the market, we are going to see about a 25% CAGR over the next 10 years. Easily moving to, say, about 3 to 10 billion in lab-grown diamonds itself, because we see lab-grown diamonds moving to about 10% of the market in about 10 years. If you just take the trends from the US, right, in 2018, just 2% of engagement rings had lab-grown diamonds, whereas today it's well over 50%. And the US market is structurally different, where they have a hero product in engagement rings. About 50% of the US jewelry market is just made up of engagement rings. And when you say there's a larger chunk of lab-grown diamonds taking place, that's a huge cultural shift. We see India getting trends about 2-3 years later. And the Indian lab-grown market is already booming. We're seeing it in terms of customer choice. We're seeing it in terms of design philosophy. And with big players entering the market, that just proves that lab-grown is just here to grow now.
But do you think that lab-grown in India will be different in consumer behavior than what it is in the US? Because jewelry purchase in India itself is different versus what we've seen in the US, etc. We buy more for value reasons than adornment.
Absolutely. If you look at the two reasons why natural diamonds were so popular, at least in the past, one is it was a social and financial flex. If you wore a 2-3 carat natural diamond, that proved that you were someone in society. It also was a pretty good hedge against inflation, which consistently outpaced or even beat inflation in many years. Both those things don't hold today. With the larger share of Gen Z moving into the market, with their philosophies changing, towards more responsibly sourced, sustainably and ethically sourced diamonds, they also want to adorn themselves with a far wider range of diamonds and gemstones. We're not just talking about lab-grown diamonds here. We get lab-grown gemstones, colored gemstones. India has such a rich history of colored gemstones, but today it's just 2% of the jewelry market. Whereas in America, that's actually moved to 10 to 15%. We are seeing a kind of explosion in terms of design philosophies, in terms of product outcomes that just weren't possible with natural diamonds because of the high cost. So it's completely turning the market on its head. And I just see it growing from here because of all these changes.
Have the prices of natural solitaires moved over the last year or two?
I'm sorry, I didn't get that.
How have the prices of natural solitaires moved over the last year or two?
Oh, natural solitaire prices have plummeted about 30-40%. I think Ishwar may be able to correct, but I think it's about at that number.
All right. Ishwar, I'll ask you a little about natural as well. And this could, I don't know how this impacts you, because Titans, apart from announcing this lab-grown foray, they've also gone all out in natural diamonds, saying that, the new Tanishq stores have a natural diamond purity meter, quite similar to what they had done with the carat meter when they had first launched. That was an industry disruption. And now everyone's looking at the carat meter as a necessity before they go ahead and buy gold. So do you think this could be something like that? And if Titan were to do it, why would anyone come to IGI?
I think there's an important aspect that we all need to consider in terms of an independent certifier. I think IGI plays that role. because there's obviously a need for segregation of duty, or as you say, avoid of conflict in terms of the certification of diamond goes. So as an independent body, I think the need for an independent body to continue to grade diamonds is an important aspect of the entire industry, the way it functions today, in terms of providing that sort of sanctity to the final consumer who's buying this product. So from that context, I think the need for an independent certification will continue to exist well into the future. But having said, just to add to some of the points that was mentioned earlier, I think there's also an aspect of prices of gold and silver, which have really moved up over the last 6-8 months. Lab-grown with their pricing at the moment provides that a balance from a budgetary standpoint for consumers to therefore participate on a larger scale as far as purchasing lab-grown jewelry is concerned. I think there are a lot of dynamics that is currently at play in this industry in terms of the way prices of gold, silver have moved, etc. And therefore, the lab-grown segment therefore has the potential to really leapfrog over natural diamonds in the future.
All right, we'll take that and also see how that impacts your overall business, because realization is lower in lab-grown for your testing, while the volumes are a lot higher. Will that offset each other for your business to sustainably grow, basis your guidance? Something that the street will keep watching out for going forward. Prajay, last word. With Titan entering, how does that change the supply side dynamics? Yes, demand, we understand, can grow about 20-25%. Earlier in the past, there were reports of oversupply in the lab-grown business. Do you think with a larger player entering here, that gets mitigated a little bit?
I think there is a tremendous supply, and especially with the high tariffs being put up by the US, that actually reduced prices quite a bit in the last, say, 2-3 months, because a lot of the supply that was going to the US today is now being flooded in India. So I absolutely don't see Titan entering the market putting upward pressure on prices. There's plenty of supply to go around.
Okay, all right. Mangalam, so you're buying a diamond or no?
Natural lab-grown, anything.
Lab-grown.
I'm sure people at home wouldn't mind.
It's of no use to me, to be very honest.
I'll tell you, tomorrow is the first, right? So come in with some bling.
Yeah.
Come in with bling.
Buy with one of those chains with some.
Look like a rap singer, maybe, I guess.
Gentlemen, thank you very much for joining us. Good speaking with both of you. Very interesting and fascinating discussion. Wishing you the best for 26. Appreciate it.
Yeah, best wishes for
Sparkling
the
2026.
Thanks for having us on, guys.
All right. Well, Nagaraj Sethi is with us for HDFC Securities with a quick word on the market before we go any further. 55 points up, so 25,990. Nagaraj, what would you recommend? Indices, stocks, both?
Yes, good morning, Prashant. Yes, Nifty found some support around 25,800 levels. The higher tops and higher bottoms on the daily chart is indicating there is a possibility of buying emerging at the lower levels. And the overall near-term chart remains intact. We are moving in a range at the higher, though Nifty facing stiff resistance around 26,200. 26,300 odd levels. At the lower levels, consistent buying is coming, which is indicative of higher tops and bottoms on the daily and weekly charts. So market is preparing for a base, and we could see Nifty sailing towards 26,300, 250, 300 levels in the near term. And I have two stocks to discuss. First one is from the PSU banking side, Indian Bank. Chartically, Indian Bank has been moving in a range-bound action over the last couple of weeks, and since yesterday it has broken out the range. The overall chart pattern is looking positive. Currently trading around 824, 825 levels. One can look to buy at this point of time. 875 is going to be the immediate target. One can place a stop loss at 790. And the second one is Industover. Industover has been in a constant uprun over the last many months. The larger degree chart pattern is indicating a strong bullish bias for the stock price. Currently showing a consolidation moment at the highs and expected to break above the consolidation moment. Currently trading around 425, 50, 426. One can look to buy at this point of time. Initial upside target would be around 450, 455 levels, and one can place a stop loss at 415.
Okay, all right, Nagaraj, we'll leave it on that note. Thank you very much for all the trading ideas for now. By the way, the mid-cap market is doing really well. The mid-cap index is up 0.5%, outperforming the Nifty quite nicely. So it's so far so good on the last day of 2025. Let's do one thing. We'll take a break, come back with the commodities on the other side. We'll ask Manisha about all that sparkle and all that volatility in the precious metals market. Well, it's the end of the year and we are finishing it off in style and sparkle. You just heard that discussion on lab-grown diamonds. Now, whether they're lab-grown or natural, you need to embed them in some precious metal. And those metals have been driving everybody really up and down all over the place. Let's go to Manisha now. Manisha, my goodness, again, 7% down, 5% lower, then 7% higher. What's the latest now?
This is not looking like an year-end at all, the way the markets are moving. But just because you were talking about the diamonds there, if you look at the natural diamonds, the smaller category, that prices have declined by 10% in this year. And the lab-grown prices have declined by 22% in this year. Is the reason people are not buying so much gold and silver, but they are buying studded jewelry, which has, diamonds of whichever kind into that. But we'll talk about commodities that are actually traded. And I want to start with crude oil prices because this is the only one that has seen a very sharp decline. It's the biggest annual decline since 2020 coming in for the crude oil prices. And we are down by 18% in 2025. 2025 actually is the third straight year that you have seen a negative return come in for the crude oil prices. Well, it is supply glut, which seems to be overweighing the geopolitical tensions in the global markets, and that has kept the prices in check and in the negative there. Now, let's talk about the positives. And yes, today, even as it is 31st of December, you have seen big moves come in for many of these commodities. I'll start with copper, and we are trading at near all-time highs in US, on London Metal Exchange, in Shanghai, and in the Indian markets as well. So when you look at the copper prices, we are up by 45% in 2025, and this is the best annual gain that you have seen since 2009 come in for copper. Take a look at aluminum, and that one is trading at a 3-year highs. We have seen 17% of gains come in for aluminum in this year. Zinc is up at a 1-year highs, and 5% of gains is what it's given you in 2025. Let's talk about the precious metal prices now. And well, yes, the CME margin hikes do kick in today after business hours, so that they come in force from 1st of January. So it's not really going to be a holiday because you will see big price moves continuing there. Silver is up 162% in this year, best annual gain since 1979. Gold is up 66% in this year, 53 record highs in this year, and the best year that we've seen since 1979 as well. Take a look at palladium prices. We're trading at a 3-year highs onto this one and 73% gains here. Platinum prices have hit all-time highs in this year, and we are trading with 123% gains in sense of platinum as well. I mean, show me in equity markets and other asset classes, and you haven't seen that kind of a move come in the way we've seen in precious metals there. I also want to talk to you about soft commodities, and they haven't done well, and it's the reason that you weren't worried about the inflation part of it, because rice is trading near 8-year lows in the international markets. It's a 32% of a decline. Cotton is trading at a 2-month highs, but with the kind the year has gone by with higher surpluses in major producing countries, it's down by 6%. You have rubber, which is trading at an 8-month highs currently, but that also has seen a 7% decline in this year till time. And then the declines just about continue, because when you look at the sugar prices, well, that is trading at 2021 lows, and we have seen 23% of a decline come in for the sugar prices. Soybean is the only one trading on the higher side there. But when you look at the coffee prices, we also have seen a very erratic year, but 10% of gains in coffee is how we're closing this year. So that perhaps is what your leeway is from 31st December to 1st Jan.
That's not bad. In diamonds down 10%, coffee up 10%. I think we can deal with it. But yes, the precious metals rally has been the one that's absolutely breathtaking. Thank you for that, Manisha. Well, with that, we will take a very quick break. But on the other side, we get to discussing one of the biggest themes of 2025, data centers. The boom is well and truly underway here in India. Whom does it benefit? What is the kind of build-out we're talking about? And where is the investment opportunity? We'll discuss this with Amit Sareen of Anantraj and Darshan Hiranandani of Yota Data Services.
Okay, welcome back. India's data center capacity is set for a massive surge, projected to expand nearly tenfold by the end of 2030. What's driving this explosive growth? Who stands to benefit the most? Winnie is here with some perspective, and we dive straight in after that into a very interesting discussion. Winnie, take it away.
Right, thanks for that. So India's data center sector has marked 2025 as the breakout year. Capacity expanded from 0.5 gigawatt in 2020 to 1.6 gigawatt in 2025. fueled by 30 times the data traffic rise since 2017. 900 million internet users also came into India, and AI usage started increasing. And what was interesting that made OpenAI India market, OpenAI's second largest market. Now, in 2025, what more did we see? We saw mega investments that came in. Reliance Industries unveiled world's largest Jamnagar data center plus 1 gigawatt AI facility with NVIDIA. TCS launched its Hyperworld for 1 to 1.2 gigawatt AI-graded capacity over the period of 5 years. OpenAI committed to 1 gigawatt amid DPDP Act mandates. Now, the total announcement that came in for 2025 hit $63 billion. $43 billion was ex of Reliance. So, yes, $20 billion approximately was Reliance. Now, with hyperscalers leasing 97.9 megawatt in first half itself, 48% increase over there is what we're seeing on a year-on-year basis. Occupancy at 97%. Mumbai dominating 50% share as well. Now, India added a record 30 gigawatt renewables in FY 24-25, making it third globally, enabled by cheap solar power, supportive government as well. For renewables versus other countries, how do we stand for AI data centers, which need 5 to 6 times more energy? Now, power demand from data centers globally is estimated to grow at a CAGR of 17% till 2030. For India, it's expected at 33%. And with the US and EU power queues that are increasing there, execution timelines are increasing, there is permitting delays across the globe because of all these issues. The focus now shifts to India. India's data center capacity is projected to increase rapidly in the coming years, and obviously because of the factors I mentioned. Now, it's interesting to note that when data centers are created, 45% of it is capex cost is non-IT equipments capex, whether you look at it like a cooling system, electricals, construction, etc., which accounts to most of the costs. IT costs come in at 55%. And India has no dearth of players in terms for equipment play, whether you look at an L&T for EPC, Cummins for backup power, there is infrastructure that is required, there are cooling systems that is required, so we have Voltas for that. Wiring, Polycab could benefit from that as well. So this will boost what? L&T, Cummins, Voltas, a dearth of companies that we have that will benefit from this as well. Now, in US, when you look at it, utilities present in the right region or even in companies which have access to electricity have seen a bigger success in the US versus other companies. In India, currently, most data centers are present, located in Mumbai region. 50% capacity is in the Mumbai region. Why? This is due to network access that is there via undersea cables. Further, when you look at it and break down India versus US, unlike US, India is one nation, one grid. Although transmission is becoming a big bottleneck similar to US, but India's data center capacity is maybe set to rise almost 5 times to 8 gigawatts by 2030. And this is according to Jefferies. Setting up 1 megawatt of data center in India requires a capex of $4 to $5 million, and hence setting up incremental data center capacity of 6.4 gigawatt by 2030 will need a capex of around $30 billion. Should create many opportunities for real estate players, electrical power systems, fit-out players, cooling systems, and network infrastructure players as well, which are among the top beneficiaries for the data center boom. And Indian telecom players, EPC players, power players, IT players, all these are set to benefit going forward with this data center boom.
Vinny, thanks very much. That's very, very useful context for our discussion now. Amit Sareen is with us, Managing Director at Anantraj. Amit, good to have you with us here. We also have Darshan Hiranandani, Chairman and Co-founder at Yota Data Services. Darshan, good morning. Great to have you with us here, as always. First up, season's greetings to both of you. And I think, for much of the industry and markets overall, I don't think we can say 25 has been great, but I think for your industry, it's been pivotal, at least in terms of what we are seeing globally and maybe what we are seeing here in India as well. Vinny put out some of those numbers, and Darshan, I want to start with you. There is this demand for AI compute, which needs data centers, which in turn requires power. I mean, I think every 3 months, forecasts for how much incremental spend will go into data centers has kept getting bumped up. This is what we've seen through the course of 2025. And it's a moving number, but it's always higher. So just give us your perspective. Where do we stand at this point in the industry, in the build-out in that sense? Give us a brief global perspective, and then bulk of the discussion I want to focus on India. Go on, Darshan.
Okay, so basically, India was playing two types of catch-up. One, we were playing catch-up on conventional cloud, which is just the shortage of data center capacity that we had for our regular compute that was stored overseas. And the market predicted that by 2030, that itself needed to go from our present 1.5 gigawatts to 3 gigawatts. Now, just to let you guys know, moving from 1.5 gigawatts to 3 gigawatts, everybody only talks about data center capex. But the point is, you can't have a data center unless you don't have computers and servers in those data centers. So just at a very high level, if 1 gigawatt or let's say 1 gigawatt, or we want to add 1.5 gigawatts of conventional cloud, that will cost 6 million of capex per megawatt. So you're talking about $9 billion of capex just needed in making the buildings with MEP. This is if we are going to 3. I'm not even talking about 6 and 9 and 10. I'm just talking about 3. Second is you need 20 million per megawatt of cloud capacity. So that we are talking about another 30 billion in capex just in your regular conventional cloud capex of regular CPUs, servers, networking, storage, some amount of software systems to enable that. So just to do our regular CPU catch up, we need around $40 billion just there in the next 5. This is without AI.
Okay, Darshan, sorry, let's just take it slowly. Lots of numbers there. What's the capacity now?
About 1.5 gigawatts.
Okay, you're saying to go to
1.6, doesn't matter.
Okay, so to go to 3,
yeah,
which is to add about 1.5 gigawatt, you're saying what's the total, everything included, MEP, cost of land and building and the servers, computers, everything? It's how much, what's the investment required?
Minimum we require around 40 billion.
Vinny put some of those numbers out, and that some of the commitments have been made in that sense, right, Darshan?
Yeah. So now let's look at what those commitments entail, right? So, for example, in some cases it is a full cloud commit. In some cases, it is just a data center commit. If it is an AI commit, then the megawattage is lower. So, for example, there's a big announcement in one of the eastern states in Andhra about a big data center complex coming there and a big hyperscaler location coming there. Now, if that is going to be used for AI, then the cost is almost 40-50 million a megawatt, right? And then if you say, oh, they've announced 15 billion of capex or announcements over the next 7-10 years to be deployed, that actually is only 300 megawatts. So when we are talking about getting to 3, 4, 5 gigawatts, we genuinely have to build these data centers, connect them, get customers, put it up, deploy the cloud, and make it all happen.
Yeah, Darshan, sorry.
Let's look at it at minimum.
Yeah.
At minimum, we are saying that we will go to 3. We are likely going to go to 5 gigawatts by 2030. So somewhere between 3 and 5.
And the cost, I mean, data center.
The capex for that. Yeah. The capex for that will be somewhere in the order of $70 to $80 billion in getting there.
So
this estimates are, because you said per megawatt cost for conventional cloud and AI is vastly different. Is almost double.
That's only for this compute. So I would say it's around 6. Let's say. Yeah, okay, almost double, 70% more.
So the number, Darshan, that you gave us, which is roughly speaking investments of up to 60 to 70 billion dollars to build this capacity of 3 gigawatts plus by 2030. This is for, we're not talking AI enabled data centers, or does it? These are just the cloud enabled or the one step below AI data centers. Got that? So that kind of gives us a broad framework to work with. Now, here's the thing. I'm going to ask the question that all investors have on their mind. This is a multi-year opportunity that I think there's no debate around. The question is, how can investors play it? Until the time that we have scale, and a lot of these data centers are put and packaged, say, in InvITs. Now you have REITs, so you can play real estate through that. Till we have the whole InvITization happen, people are trying to sort of move ahead of the curve. So Amit, come in over here. So construction, land and development, just, creating the housing structure is one part of it on which some capex is going. But I don't know if that is the most interesting way of playing the data center opportunity. From a real estate standpoint, what's in it for you? And where do you see the value add coming in?
Surely, this is where we start. The first thing, like Darshan rightly pointed out, the first thing which we need for a data center is the land in the building.
Yeah.
But that is just the starting point. And then it starts from there. We've been working in the data center space now at Anantraj for almost about 7 years now. We started this in 2019 when our founder chairman, decided that we are going to go into this. Today at Anantraj, we have 157 megawatts of buildings which are now ready and which are now getting converted. And we have 28 megawatts of co-location already there. So the way we are approaching it, we've kept it very simple. We feel that the data center business in India is going to grow in two segments, basically. And then, of course, there is AI and there is a whole new world to it. But these two things are going to be required by everybody who wants to come into data centers. The first is co-location. When you go up to the rack and you provide the complete infrastructure, which is what Anantraj started with. And once we delivered that product, we got very good demand for it. And, based on the product which we delivered in the market, we also got demand for cloud, which is infrastructure as a service. Cloud in itself is a huge horizon. It comes, AI is one part, and then there are several other parts. But the way we looked at it, Anantraj, was we initially started with infrastructure as a service on the basis of cloud, where, of course, the investment is almost 4 times more than what you do in co-location. We did that, and today we, last year in October, we started Ashok Cloud, and we got phenomenal response for it.
So Amit, help us understand. I'm sort of going into level 2 now. From a business standpoint, basically a margin perspective, you're making investments. So what is the kind of ROI? What is the kind of margin that this business is going to fetch you? Like you said, there's the base model, which is just co-location, taking a spot on the server. And then the other model, which is more high-end, infrastructure as a service. Just give us the business dynamics, the margin profile, and the ROI on both of these.
Surabhi, the ROI when you start with co-location is almost 60 to 70%. And when you move from co-location to the cloud services, which is like we just told you initially, infrastructure as a service, which is like basic cloud, there the ROI even touches almost 80 to 85%. So as of now, this is a very lucrative thing to look at. And in spite of the ROIs we are telling you, India is amongst the cheapest, both in terms of capex and in terms of opex in the world. So that is a big advantage. As of now, we are all talking about only the Indian data getting localized. As you know that how this whole data center story started in our country was our Honorable Prime Minister was the first leader in the world who spoke about data localization. And today, India wants to localize its data. So as of now, we are focusing on this. But the advantages we have in India, both in terms of capex and opex, maybe after 2032, we can look at even importing data and keeping it here.
Okay. Got that. Darshan, this dire, if this build out has to happen, and globally we're actually talking about hundreds and hundreds of billions of dollars. I mean, if some of the numbers have to be believed, it's mind-boggling. And people will go through bouts of skepticism once in a while about whether this is all going to happen, etc., etc. And there is always this concern about too much commitment, overbuild. We've had, lots of these episodes earlier as well. Something changes, you realize that, well, productivity, the ROI, the realized ROI is not what you thought it was. Or something like DeepSeek happens and everybody then, the cost of compute goes down significantly and you're already committed to all this investment. So things can change and these are all questions. But in India, Darshan, do you think we are, like in most other sectors, so low in terms of actual capacity that even if all of this were to play out through 2026, the industry is set for, some of these things have been locked in at least for the next 2 years, 26 and 27?
No, I certainly think things have been locked in for till 2030 because the market has just woken up. They've hit the hammer into the ground. Today, it's going to take time to deliver results. Infrastructure can't be built overnight. Servers can't be delivered overnight. Cloud systems can't be connected overnight. So that's not going to happen anyways in a hurry. I think right now, the reality is we're looking in certainly next, I'd say 3 to 4 years, we're looking in at a very good run because even global capacities today are not really coming online in a large enough scale. So there's still a lot of announcements, still a lot of contracts, but large enough capacities haven't come online. But in an India perspective, we are very far behind even on our conventional cloud. So there is less risk of this over build out, whereas America had reached a point where they had satiated and stabilized conventional cloud. And then the AI boom came and then they said, we want to create AI for the world. So that's what they're doing. In India, even if we just focus on the compute capacities for India itself, at the current rate of rollout, we've still got 5, 7, 10 years of it. Just in terms of ROI, I think the point that was asked, my view is maybe a little different. We are looking at typically co-location paybacks are around 7 years, 6 to 7 years is your payback on co-location. So if you consider an ROI, it's like between 13 and 14% typically. If you look at cloud sort of investments, those are much quicker because of course the servers also depreciate much quicker. So you have much quicker paybacks, much better returns, but you have a higher depreciation cycle. So you can only invest in those when you've got visibility and throughput of customers in place.
So what is the ROI, Darshan, in that case? And what's the return period?
So typically, let's say you're looking at a cloud compute sort of period. Typically, you get a full payback of the entire infrastructure anywhere in 3 to 4 years. So that's fully paid back. And the life of these servers is, some cases 6 years, some cases 8 years, but depends on what the compute is.
You know that there is a flash going, some 1 gigawatt, $6 million. That is wrong. We should take it off and correct that.
It's only of co-location.
So, sorry, what is that, Darshan?
It's $6 million is co-location cost to build out. So if you do MEP, if you do just the fit out, that's $6 million per megawatt.
Oh, megawatt. Yeah, no. It was growing as gigawatt. So Darshan, if you were a private investor with the knowledge that you have running Yota, where would you look to invest? Which part of the value chain?
I think currently the biggest I think the part of the value chain that's key is where you can get sector-specific data centers and you can get Indian cloud providers who are moving in scale. I think those would be two that would go really well. I think as an offshoot, on the listed side, you can create another basket of portfolio of a lot of the MEP and other players who are going to be providers to this space. I think it's going to be net positive to all of them, generator sets, MEP fit-outs, electricals. But people who have a large enough focus into this vertical would be key. I wouldn't generally say all electricals will do well, but people who are focused on data center electricals will certainly do well. That CapEx is going to be big.
Got it. Okay. Amit, for my last question from my side, are you sort of putting Anantraj out as one of those companies? Which I'll
tell you one thing I just want to point out, like one of you just mentioned about DeepSeek. I tell you, if AI becomes cheaper, our only aim is that the requirement for data will further go up.
Yeah.
Just imagine when AI becomes cheaper, there are more and more users who are going to be using it. So the requirement for data will further go up. So that is something we at Anantraj are betting on. And the ROIs I spoke about are basically of Anantraj because, in our case, like we told you in the beginning, 157, the buildings are now ready. So the additional costs which are increasing, that is exactly the ROIs we are earning right now. So we are fully on track, whether it's the co-location and the cloud. In the cloud, we have today no botheration about AI getting cheaper or not getting cheaper because we are simply storing data right now.
Cheaper it is, the more the data consumption. Take your point, Amit, and good to have that clarity. But every investment thesis does go with a disclaimer, the downside scenario or the risk. So, to this, what sounds like a fantastic multi-year, thesis, what could be that downside risk? Very quickly, 10 seconds each. Amit?
I'll tell you, Surabhi, right now, for the next 3 to 4 years, we don't see a lot of downside in this business at all. Okay. After 4 years, maybe let's see how much competition comes in and what all comes in. But in the next 4 to 5 years, we don't see downside, number one. And number two, the capacities we are creating and with the ROIs we are talking about, we are actually ready for competition if it comes after 4 or 5 years. But I think we still feel that the demand will still keep on increasing.
I think Darshan echoed the same thing in India. I'm sorry we're interrupting both of you. Amit, my question was, so give us a sense, next 3 years, what kind of numbers should investors expect from Anantraj? Just growth rates, what you presented to investors. I think you've done roadshows, etc. as well.
Yeah, of course. See, we are already at 28. By next year, we'll be 63. And the next year after that, we'll be 117. So for this, everything is on track. 25% of what we create will go towards Ashok Cloud, where as of now, we are providing infrastructure as a service, which is the basic level of cloud, where we don't see a lot of competition coming. And it's pretty simple. We just keep the data. And the balance 75% is co-location, where we are dependent on hyperscalers, for which we already have the tie-ups in place. So things for the next 3 to 4 years in Anantraj are the roadmap is very clear.
Those numbers that you mentioned what is the 115? All that is?
Megawatt. It is the megawatt.
It is a megawatt. Okay. You'll go up to 115 megawatt by?
By 32, we get to 307, for which we have everything.
I see. Okay, got that. Gentlemen, thank you very much, both of you, for joining us. And it's a discussion which we will sort of keep inviting you for through 2026, because I think if there is one area where there is large amounts of investments going in globally and in India, it is data center capex. Amit and Darshan, great to have both of you here. And once again, wishing each of you a very happy 2026.
Thank you, everyone. Thank you.
Thank you. Thank you so much. Thank you, everyone.
Okay, I think, that gets us, guys, to the last Bazaar of 2025. I want to say 2026. 2025.
No, 25.
Don't worry, we'll be back with the first Bazaar of 2026 just tomorrow.
And Surabhi, for you, last Bazaar for now.
Last Bazaar for now. I won't be there for the first Bazaar of 26, but I think this discussion was a very sort of good one to end on for me, because it's all about digital, it's all about disruption. So going forward, I think I'm going to go back to some experimentation with what I call the OG digital business news brand that this country has seen, and that's money control. So more experimentation, more disruption, figure out newer digital formats on the other side, but right around the corner.
Right around the corner. So what we'll do is we'll wrap up on this edition of Bazaar on that news, and stay with us because a lot more updates on your way. The market above 26,000 in the first half hour of the last session of 2025.